Ladies and gentlemen, distinguished guests, good morning and welcome here in Porto Roche at our conference on the financial markets in the region. It's an event jointly organized by International Monetary Fund and our bank, Banka Slovenije, and actually it's a revival of a series of events we started 10 years ago. Back then, in the aftermath of the great financial crisis, we were discussing what the banking landscape would look like after the crisis, and the questions like capital adequacy, revival of credit flows, and the position of domestic versus foreign bank in the region were the forefront of the discussion. Fortunately, today these topics are in a back row, and we can focus more on a more medium-term perspective on more structural issues. And let me give you just two brief examples what I have in mind with that. The first one is related to the banking sector. Namely, our countries, so countries of Central, Eastern and Southeastern Europe, made a significant progress in past 10 years, maybe even past 30 years, in terms of convergence of GDP rates, in terms of how open we are and how integrated we are into international flows, and also in terms of financial development. However, the development was not evenly spread among these three categories, and the fact is that in terms of banking sector, we are still lagging behind. To give just one indicator, the share of banking assets to overall GDP is amongst the smallest in the EU. And the second example is that the banks are still operating with relatively simple, basic business models. And the second example is related to a more broader picture to the financial markets in general. And here, the lag is even bigger. Namely, if we are comparing the size of our financial markets to the size of those in more developed countries of EU, the matrix is around 1/4, so 25%, which is a significant gap. And that's because after the initial push we received from opening our economies, from privatization, the development stagnated basically in the past 10 years. And the main question, the main topic of today's discussion, of course, is what to do. What are the solutions? How can we advance the development of the financial markets? And there is one very obvious solution, and that is capital markets union. We learned from our past experience that small economies and small and open economies cannot survive alone. We have to cooperate, we have to be part of some bigger formation, and this was our experience from the past with the EU, with the euro area adoption, and also experience on the global level. However, we must be realistic and be aware that out there is a lot of discussion about the capital markets union, but the project seems to be very elusive. We are discussing it for many years, probably for a decade, but we are still at this stage. We are discussing. And the same holds true for the banking union. We can say that it is a project, but project in a progress. So our ambition for today's conference is to find an alternative solution, to discuss alternative solution and see, is it possible to achieve some smaller kind of integration, something compared to what Baltic states did in the past? Maybe this is one way to go. The second would be, is it possible to do some changes in terms of legislative framework? Can we simplify it and achieve a progress towards more developed financial systems? And the third option maybe is that there are some localized initiatives like rising awareness, rising financial literacy, and then helping with some instruments like retail bonds issued here in Slovenia, in neighboring Croatia, and some other countries as well. So all that will be for today's discussion. Of course, ladies and gentlemen, we are well aware that financial markets, well-developed financial markets, are prerequisite for investment, for productive investment, for innovation, to fostering growth, and then to achieve progress. From our perspective, from the central bank perspective, they are also very important for monetary policy transmission. Our restrictiveness, or for that matter, our accommodation, cannot work evenly across all the jurisdictions if the financial markets are not well developed and well aligned in this development. So this will be the topic of today's debate, and we are planning to divide it into 3 parts. The first one will be dedicated to the banking sector, to open challenges in this area. Then the second one, we will discuss non-banking financing and capital markets, financial markets more in general. And the third one will be, I hope, very policy-oriented. We will try to find a solution. But before we start with the panels, I would like to invite Mr. Alfred Kammer, Director of the European Department at the IMF, to give us his keynote speech to set the tone to the whole debate. So, dear Alfred, please, the floor is yours.
Thank you, Governor Vasle, for your opening remarks to this joint Banka Slovenije IMF conference. And ladies and gentlemen, welcome to all of you. And I hope this will be a very exciting day where we are sharing some diagnostics, looking at some policy conclusions. And as the governor said, it's a call for action. Because when you're looking at capital markets issues, in the area, in the European Union, too little has happened, and Europe has been left behind. Now, let me start on a positive note. Europe withstood the test of the twin crisis. Despite the pandemic in 2022 and the energy crisis sparked by Russia's invasion of Ukraine in 2022, unemployment is at record lows. Banks are sound, and we at the IMF project growth to recover and inflation to go back to target. This is really also a testament of what policymakers achieved to pull us back from the abyss in the pandemic, but also the Russian gas shut off. And it shows the power of policies on the central bank side and on the fiscal side. In the region, Central, Eastern and Southeastern Europe, CESEE as I will call it, this resilience comes on the back of 2 decades of robust growth. Growth that was based on integration into Europe's value chains, often financed by FDI, a model that has paid off. Over the last 2 decades, real economic growth averaged 4%. A sophisticated financial sector was not needed. Bank finance dominated, complemented by funding out of own resources and foreign direct investment. But there are 2 important caveats. One is that investment has generally been too low to close the capital stock gap with other advanced economies. The other is that the world has changed. The model of the past will not be fit for the challenges of the future. I want to spend the next few minutes outlining what a new growth model could be and what kind of financial system is needed to support this new growth model. So let us look at where we are and what has changed. Despite CESEE's progress, convergence to higher income levels has slowed, and the gap to the global frontier, the US, remains large. Those not part of the EU have the income per capita of the US of the mid-1950s, when the wall dividing East and West Germany had not even been built. Those in CESEE, who are part of the EU, have the income per capita of the US of 1986, shortly before the Berlin Wall fell almost 40 years ago. Put differently, the income per capita gap to the US amounts to 45% in 2023. That's a lot of money that has been left on the table. CESEE's income gap to the US is about capital shortfall and lack of technology. 2/3 of the gap is explained by lower productivity, and the remainder reflects the lower capital stock. And this is precisely where the old growth model has started to fail. Productivity growth is slowing, and the capital stock gap stopped narrowing. The productivity deficit extends across sectors. And now here, this is a chart which is really worth looking at and considering, and we would call it a killer chart. The share of CESEE's high productivity sectors in total output is at 5% of the total. This is about a third of the rest of the EU. But both CESEE and the EU are far behind the United States, where high productivity firms are accounting for 44% of value added. Instead, the share of low productivity in CESEE is much larger than elsewhere. So to enhance productivity, CESEE requires more or larger firms closer to the productivity frontier. This means investing in technologies to enable low productivity firms to catch up, developing new technologies to elevate medium productivity firms to become high performers, and nurturing new high productivity firms to grow. There are also new headwinds. First, a weaker global medium-term growth outlook, as described in our April World Economic Outlook, implies lower foreign demand. And this does not bode well for FDI prospects, which already declined post the global financial crisis. Second, economic fragmentation is rising. This casts another shadow on the old growth model. There are no guarantees that existing value chains remain relevant. Changing trade patterns and structural shift, such as artificial intelligence and climate change, require reallocating resources across sectors and larger investments, including in intangibles. CESEE's growth model needs to adapt to these challenges. So what will it take? A new growth model needs a financial system that is fit for purpose. And that means a financial system that supports innovation and adaptation. As a rule, innovators that bring productivity gains by means of creative disruptions have little own resources, especially when it comes to research and development spending. They also have little collateral against which they can borrow. And at a later stage of firms' development, financing is needed to bring inventions to scale. A well-developed financial system caters to these different business risks and provides the menu of financing options over the firm's life cycle. It meets the needs of new firms, of established firms, as they upgrade or expand, and it allows for the growth of firms as they explore markets. Such a financial system also ensures that savers find attractive options for their risk-return appetite, and capital is channeled efficiently into productive capacity. Measured by expected growth, capital should flow to CESEE firms, since the implied return is well above that in advanced Europe. It doesn't. According to the European Investment Bank, their surveys find that financing is insufficient. More firms in CESEE are financially constrained compared to the EU. Those that are leading innovator firms are usually even more constrained. And fewer firms in CESEE are content to rely on internal finance. As a result, 30% of firms perceive they have not invested enough. And the scope of financing is not supportive of frontier technology adoption. The system is bank-based, which tends to favor conservative lending, not least because of the prudently regulated nature of the bank business. This bank-based system primarily supports investment in machinery and equipment, not intangibles. And according to recent research by UNCTAD, it is the determining factor holding back CESEE country rankings in the preparedness for adopting frontier technology. These limitations are reflected in CESEE's level of the capital stock, which is too low and has way to go. Lifting the capital stock to the level where advanced European economies stood in 2000, that goes hand in hand with rising productivity, especially for intangible capital, could more than double income in CESEE. So let us take a closer look at where CESEE's financial system could improve. Much of the corporate sector draws on banks for external financing. Here, CESEE has two gaps that hold back financing. First, intermediation needs to grow. For every euro deposited, non-CESEE euro area banks provide credit to the private sector worth 86%. For CESEE, this ratio currently stands at €1 to 73 cents in euro area members and 55 cents for the others, 86, 73, 55. Three factors contribute to the lower intermediation: limited collateral, lending conservatism amidst low recovery rates and post-GFC caution, and lack of competition. The latter is evidenced by structurally higher bank profits in CESEE than elsewhere in Europe. Second, financial depth has clearly some way to go. Savings deposited with banks fall about 30% of GDP short of peers in the euro area. 30 percentage points of GDP. Limited financial literacy and trust in the banking sector are potential culprits. According to the Austrian National Bank Euro survey, only 20% of individuals have a savings account in several non-euro area CESEE countries. There appears to be a preference for cash holdings over interest-bearing assets, often reflecting individuals' lack of trust in the banking sector. More deposits would expand available financing resources and bring down the cost of capital for firms, the primary reason for dissatisfaction with access to bank finance, according to a European Investment Bank survey of firms. Banks can step up, but banks alone are not the answer. They are less suited to finance riskier ventures inherent in the business models of innovative firms and startups. Capital markets are the more natural fit. They cater to longer-term investors that accept higher risks for higher expected returns. In fact, the very absence of large capital markets and their promise of financing quells incentives of entrepreneurs to establish or grow their businesses. Currently, capital markets in CESEE punch below their weight. Equity market capitalization in CESEE stands at about 20% of GDP. The corresponding value in the euro area is about 55% of GDP, and in the US it's a whopping 160% of GDP. This is a huge shortfall, but also a huge potential. Growing the size of capital market means finding demand for new market instruments that fund productive investments. Institutional investors, such as insurances and pension funds, are the traditional counterpart, but their role in CESEE is limited. In the US, assets of these intermediaries exceed 250% of GDP, and in CESEE, their assets stand at a staggering 1/10 of the US level. Together with the large home buyers of these investors, more than half of equity portfolio invested in their own countries, and fragmented capital markets in Europe, the scope for firm financing through capital markets is constrained. Finally, venture capital, a form of private equity, is arguably the highest risk-return funding source. Venture capital is critical for a growth model based on advancing the technology frontier. Venture capitalists not only provide financing for innovation, which are hard to collateralize, but also provide value added by advising, monitoring, and supporting their chosen firms and projects. In most of CESEE, venture capital lacks more advanced country peers. On average, venture capital as a percent of GDP accounts in CESEE for less than half the amount of financing in advanced European counterparts. The industry is characterized by fewer and smaller funds, reflecting the fragmentation of pools of capital in Europe. Its scale is held back by underdeveloped capital markets. The smaller size of stock markets in Europe versus the US limits exit options for successful startups, which ultimately impacts valuation and returns to investors. This reduces incentives to invest in startups throughout their life cycle, starting with venture capital. The Baltics have shown that it is possible to scale up venture capital, and I look forward to hearing about their experiences later today. So what can we take from this analysis? For the financial system in CESEE to support a new growth model adapted to the changing global context, hurdles need to be overcome. First, household savings allocation are too conservative. More households hold cash, and for each euro households hold in bank deposits, about €1 is held in equity or investment funds. In the US, the corresponding value in equity and investment funds is almost 4 times this value. This makes for higher returns. Second, institutional investors need to grow in importance as a vehicle to raise domestic savings and as a source for risk capital. And third, individual, smaller and fragmented capital markets in Europe with large home bias of investors imply higher funding costs in CESEE. Overcoming these hurdles would pave the way to expand the reach of the banking sector, elevate the importance of capital markets, and extend financing options. Policymakers can facilitate these changes. At the national level, the expansion of bank lending can be accelerated by fostering competition through adequate regulation and supervision to reduce financing costs for firms, improving collateral frameworks and insolvency procedures to reduce risks associated with bank lending, bolstering trust in financial institutions through transparent provision of information to expand the deposit base. Measures to elevate the importance of the capital market are improving financial literacy, which can help shift preferences away from cash to return-carrying asset holdings, and strengthening regulation and supervision, better protecting property rights, and developing the institutional investor base, including through Pillar 2 pension systems, which helps foster demand for market instruments. And large capital markets also help grow venture capital by improving exit options for startup firms. Where venture capital lacks, well-designed preferential tax treatments can help overcome information asymmetries and reap positive externalities not internalized by individual investors. And supranational initiatives can multiply these effects. Capital market union and banking union need to be completed. This means harmonization of insolvency and tax regimes, better and standardized public information on listed companies, centralized supervision and common deposit insurance. This would reduce investors' home bias, encourage cross-border activity, allow for a deeper pool of capital, and improve allocative efficiency. Put simply, borders should not matter. Deeper pools of capital in the EU means fast-growing firms that seek capital need not look to the US. Yes, this may come with some risks, but we have learned from the global financial crisis to look out for these risks and prepare. And after all, for an entrepreneur who wants to flourish, the biggest risk of all of them is not taking one. Thank you.
Inspiring introduction for today. So in this first session, we will shed light on the banking systems in CESEE region and the role of banking sectors in this environment of global financial landscape. In the CESEE region, as we have heard, the banking sector is still underdeveloped compared to EU countries, and banks still play a predominant role. The question is how banks are serving the economy and where are the possible solutions and improvements. We will first hear the introductory remarks from Mr. Wu from the IMF on the evolving global financial landscape with some implications for CESEE region, and then we'll try to answer a couple of questions with our panelists. Mr. Wu, the floor is yours.
Good morning, everyone. It's an honor to be here. I'm Jason Wu from the IMF. Thank you very much to Governor Vasle and Vice Governor Dolence for inviting us this morning. So my shop at the IMF, we do multilateral surveillance. In particular, we focus on global financial stability. And so as a non-expert of this region, I think what I'm going to do today is to first set out a global landscape in a few slides, and then hopefully provide a few facts about the CESEE banking systems to complement Alfred's speech, as well as to set the scene for my esteemed panelists to come later on. I would say that our observations about this region's banks are hypotheses, and obviously we're keen to hear from those who are actually on the ground later today. So let me start with the global landscape. As you may know, the IMF updates our forecast for the economy as well as our financial stability assessment every half year in October and April. So looking back since October last year, what has happened? According to the World Economic Outlook, real GDP growth has been revised upwards by about 0.3 percentage points in 2024 and 0.1 percentage points in 2025. So overall, the economic backdrop has brightened. For 2024, the main drivers are the US, upward revisions to US growth, as well as to China's growth. But emerging and development economies is really going to be the driver for the upward revision in 2025. With this brightened economic backdrop, it's also supported by the fact that inflation, shown in the right chart here, has declined steadily in both headline and core spaces globally. So with this backdrop, there is a narrative out there that there's a last mile of disinflation, or I guess last kilometer of disinflation. And this has fueled financial markets. The left chart here shows that markets' projection for the policy interest rates of major central banks is forecast to decline in the coming years. Lower interest rates is fueling financial markets and creating a soft landing narrative. And on the right chart here, you can see that financial markets have reacted significantly to this by lowering overall financial volatility in the orange line here. Interestingly, this lower levels of financial volatility is actually accompanied by still very elevated levels of economic policy uncertainty, reflecting factors such as geopolitics, fragmentation, but also the fact that we're not really out of the woods yet when it comes to global disinflation. So overall, financial conditions against this backdrop has eased globally. And so in the Global Financial Stability Report, we make assessments about near-term financial stability risks. And because of the easing of financial conditions, in the near term, we assess that financial stability risks have receded compared to in October. The tool that we use for this high-level assessment is the 1 year ahead growth at risk model. Basically, this models the 5th percentile of 1 year ahead global growth as a function of financial conditions and as a function of credit growth as well. And so the two distributions on the chart here illustrates this point. In October, our assessment is basically the blue distribution. The 5th percentile of global growth, conditional on the financial conditions at that time, is close to 0%, meaning that with 5% probability, 1 year ahead growth would be 0%. The black distribution is what we have in April, where you can see this clear right shift of the distribution, meaning that the outlook has brightened, and also the tail risk, signified by the black dot here, is around 0.7%. So the tail risk has actually improved in the near term over the next year. So downside risk has receded since October. It is currently around 40th historical percentile, and it is corroborated by our sector by sector assessment that the financial sector has broadly remained resilient. But that is not to say that there are no near-term risks. There are still a number of near-term fragilities that we point out. So the primary one is that upside surprises to inflation can undo some rate cut optimism, reprice financial assets with stretched valuations, and decompress market volatility. In fact, we have seen a little bit of that play out in April against the backdrop of unfavorable inflation reports from the United States in particular. Then there are fragile near-term certain fragile sectors as well that we're paying attention to, such as strains in commercial real estate sector, which could further intensify and bring down certain exposed lenders. More importantly, we are more concerned about medium-term vulnerabilities being built up again in this situation of very easy financial conditions globally. Debt sustainability challenges around the world remains, and there are signs that are mounting in both advanced economies in the top panel, as well as emerging economies in the bottom panel. This applies to both governments as well as private non-financial. And perhaps the increase in debt to GDP ratio here is the most notable for private to non-financial in emerging economies. The credit cycle downturn could intensify. What we mean by that is that default rates of corporates, of households, will continue to increase in this still high interest rate environment. And then there are vulnerabilities at several banks around the world that we're monitoring. Among non-banks, there is significant growth in assets for some of those non-banks, including private credit globally. So with this backdrop, the key takeaway that I wanted to provide you today is that we're not really out of the woods, and we may very well suffer from inflation surprises entering us into a higher for longer world. Against this backdrop, what can we say about CESEE banks? First, because we are financial stability assessors, we tend to look at resilience of the banking sector first. In particular, the Common Equity Tier 1 capital ratio, as well as the liquidity coverage ratio of regional banks. You can see here that in the CESEE region on the left chart, both the CET1 ratio in the bars, as well as the LCR ratio in the line, are very high, indicating that there is a high degree of resilience in the region's banks. And this is corroborated by various dinners discussions that I had with governors last night as well. By contrast, in the broader Euro area, you would see that CET1 ratios and LCRs are not as high as in the region. So CESEE banks weathered high rates with strong capital and liquidity so far. High rates have also boosted profitability. On the left chart here, the blue bar shows return on equity, a summary measure of bank profitability. You can see that 2020 was a very good year when it comes to CESEE banks' return on equity. This is happening at the same time when NPL ratios in the light green bars remain very low, which is an impressive feat. By contrast, in the Euro area, ROEs are a little bit lower. Nonetheless, NPL ratios are also fairly low in the right chart here. What's interesting, however, is that this profitability seems to come from net interest margins rather than high degree of bank lending. You can see in the green lines on both charts here, this is an index of total bank lending. Total bank lending has actually declined a little bit relative to the pre-pandemic times in the CESEE region, although not by much, 5%. In the Euro area, the decline has been similar on net, about 5%. But the interesting thing is that in the Euro area, there's obviously a bigger boost during the pandemic, to bank lending that is now being unwound. So overall, profitability has been great for the region's banks, but not lending volumes. The next question is, well, is this cyclical, or are there some structural factors that could underpin the profitability of the region's banks? So here, what we look at is the cost-to-income ratios of CESEE banks. There are many colorful bars here, so I'll draw your attention just to the two lines. The darker line is the Euro area cost-to-income ratio, currently sitting around 60%. And the lighter line is the CESEE region cost-to-income ratio, currently sitting at 50%. So obviously, in aggregate, CESEE banks are enjoying lower cost-to-income ratios, indicating that there's some longer-term efficiency in the banking sector to be reaped. This could be because the banks have been more nimble, they have less fixed costs. Perhaps they are benefiting from the fact that foreign banks operate and centralize costs where their home locations are. Nonetheless, I think if we put the three pictures together that I just presented, resilient capital and liquidity, fairly decent profitability, and low cost-to-income ratios, this tells us that the banking sector has room to support the real economy and expand. However, that has not been the case so far since the pandemic. Bank lending to corporates in particular, I'm going to focus on business and corporates in the next couple of slides, has much room to grow in the region, as Alfred has previously discussed. So starting with the left chart, this compares corporate loans to total loans ratio in the CESEE region in 2019 compared to 2023 on the vertical axis. So anything below the 45-degree line here on the left chart tells us that corporate loans as a share of total loans has actually declined. So you can see that many CESEE countries are actually in that category. The euro area has held fairly steady around on the 45-degree line here, whereas the CESEE region as a whole this ratio has declined from 20% to about 15%. So there's obviously more room for banks to support corporates. And what was striking to me as I was putting this presentation together was that if we look at ECB data, the sources of funding for CESEE corporates is actually more dominated by non-bank funding. This is not to say non-banks are lending to them, but just not bank loans, basically. Compared to a euro area where you would see on the right pie here that the banks in the green area really dominates. So I look forward to hearing more from future sessions about why that might be the case. Looking a little bit at foreign banks play a major role in the region. The chart on the left shows the foreign banks' asset to total bank assets in the region in the red bars, close to 60%, versus in the euro area, obviously much lower. So foreign banks can bring a lot of benefit to the region, including technology integration, including sources of international funding. But there are also literature documenting, not just pertaining to the region, but more broadly, that the presence of foreign banks in the banking market means less commitment to domestic firms and households. And so there is a little bit of a double-edged sword here. But the overall picture points us to the fact that there is significant presence of foreign banks in the region. Looking at a particular case study in Poland, where foreign banks account for about 55% of banking sector assets, what we see is that over the past few years, the lending to domestic corporates and households in the yellow and the blue areas, respectively, has stagnated, while lending to other loans, lending to other types of loans in the green area here has increased. In particular, I would also point your attention to the gray line here, the loan-to-deposit ratio. In the Polish banking system, it has declined from about 90% to 80%. So clearly, there are some lessons that we can consider when it comes to the presence of foreign banks in the region. So in light of the good weather today, I thought that I'll do some blue sky thinking here. I've actually discussed with Vice Governor Dolence whether this is a suitable case study. I'm going to bring it out just to be provocative. Let's consider a case of a banking system that underwent significant transformation without a major crisis. And I choose countries without major crisis because obviously the banking sector in the region has been very resilient. And crises usually bring about change, but it's interesting to think about how change can be brought about without a crisis as well. So Singapore. This is a case of banking acceleration without a major crisis. There are many dissimilarities between Singapore and the CESEE region, obviously. Governmental goal of developing Singapore into an offshore financial center may not be an aspiration for all countries. It also has proximity to China and other fast-growing Asian nations. But with these dissimilarities in mind, I think that there are still several useful comparisons and notes that we can take from their experience here. First of all, Singapore's inflation-adjusted per capita GDP in the early 2000s was about $30,000, roughly the same as Slovenia at present. In the early 2000s, there were a slew of banking sector reforms. This includes championing local banks by allowing the 3 large local banks to acquire their smaller competitors. There is the liberalization of activities in the banking sector by broadening the scope of lending and activities allowed by banks. This apply to both foreign and domestic banks. There is the streamlining of supervision and regulation, for example, by consolidating regulatory power. And perhaps more importantly, they set up corporate disclosure standards as well as a household credit registry in the early 2000s. So not to assign too much causality to all these policy measures, but one consequence that we've observed is the chart on the right, where you see that business loans, this is lending to corporates only, to GDP ratio has risen from 400% of GDP to close to 800% in the span of a decade, before declining more recently because interest rates are high, there is a deleveraging by corporates there. But nonetheless, this growth has been very impressive, and a lot of it went to domestic businesses, right? Singapore being an international financial center, we have to consider whether they're lending to domestic or corporate, domestic or foreign counterparts. And the orange dots on the chart here, you can see that the loan share to residents is actually very high at around 50 to 60%. And finally, local banks have grown from 25% of banking sector assets to 40% of banking sector assets. So for folks who are interested in learning more about this case, the IMF's financial stability assessment programs, financial sector assessment programs rather, for Singapore would document this case study in more details. Finally, I just wanted to say a few words about fintech and climate. We have learned from Baltic countries that fintech can help reshape banking landscapes. Just one example, in the area of instant and cross-border payments, fintechs have significantly helped promote the single euro payments area. Climate poses risk and opportunities for CESEE banks. Unfortunately, the devastating floods in Slovenia reminds us that physical risks are substantial in certain regions. Glad to see that recovery is well underway. And of course, managing transition risks by aligning with EU policies on disclosure and taxonomy, leverage technology and innovations in the space of climate and transition financing would be very beneficial to the banking sector. Thank you very much.
Thank you, Mr. Wu, for sharing your thoughts. Now let's start with the first panel, and I would invite my four panelists to the podium. So Mr. Kampa from EBA, then Mr. Vujicic from Croatian National Bank, Dinoya from OECD, and Omaham from Oliver Wyman. Please. Welcome. So first we will try to dig into some questions that I have prepared, and then at the end of the panel we will also open for your questions. Let's dig first, before going to CESEE region, let's talk about health and performance of the banking sector from slightly broader perspective. It was already mentioned that the last year was exceptionally good for the banking sector all across Europe. In the Eurozone, the trend of net interest margin shifted shortly after ECB announced normalization of monetary policy. And in most jurisdictions, the transmission of monetary policy was much stronger on the loan side compared to the deposit side. A surge of interest spread boosted profitability, as we have seen in banking sectors. However, monetary policy is likely to change, and banks would again need to adopt. And therefore, we need to think about the vulnerabilities. Mr. De Moya, the focus of last year's discussion was on banks' failure globally, but it quickly shifted away from weaknesses in the financial sector. Does this imply that there are no more significant weaknesses in global financial system? And if this is not the case, what are most pressing concerns?
Thank you. Thank you. Thanks for the invitation to Central Bank of Slovenia, Governor Basel, and then IMF, and Alfred, thank you very much. Now, I mean, it's true that we have been, we spared some from any, major financial crisis after the banking crisis last year. But I think, the point is that, I think it was mentioned, I think by Arthur, we shouldn't, we had resilience, but we shouldn't, it's not the time to guard down. I think 4 quick points. One is because the level of debt is really very big around, both, I would say, sovereign and corporate debt is this magic number of 100, meaning bond debt, corporate and sovereign, is $100 trillion US. So basically the world GDP. So it is a lot, and refinancing, and for OECD countries, we estimate at the end of 2024 we will have still a level of 54 trillion. So it's a lot. And if funding needs remain significant, there is less margin of error, I would say, for policymakers and monetary policy. This is put it very, very simply. The second thing is that is corporate refinancing risk. This is an issue. We're going to have nearly 40% of the global outstanding of corporate bond that is going to expire in the next 3 years. And these they were issued basically, very good, in favorable times, is great, but typically a fixed rate. So now refinancing, we will see the effect of the new monetary policy. So it's going to be an issue, and we are, we issued recently our global debt report, both on sovereign and corporate, and is something that can be tricky. The third thing I would say, banking crisis and, SVP Credit Suisse show that, even in, I would say, simple cases, because this was a basic, if we say macro mismatch, interest rate risk, but no one saw it arriving. And so risks are always everywhere, and they can, pop up. And so we should be careful, because somewhere they are in the system. And the fourth thing, and I stop, I think Alfred mentioned also, we have an increasing fragmentation, in particular of capital markets. And, we need capital markets. We see all, empirical evidence that obviously having liquid, resilient, integrated capital markets can be, other things being equal, a good, hedge against the crisis. Fragmentation is still there, and I think so we should work on this. Then, given that globally, but we will discuss, I think, in the panel and also in the conference, the region, proven, resilient. Again, we hadn't major issues. There is a demand, but I think initiatives and international cooperation is there. Vienna Initiative and others. But I think we need to be careful.
Thank you. Mr. Kampa, you have a leading role in the creation of regulatory framework for banking system in the EU. What is your view on the role of regulation and completion of banking union? Looking back at the events in US banks last year, it's obvious that banks in European Union were obviously spared from major turbulences. Has a strict regulation, application of Basel III and strong supervision helped in this context? And in addition to that, maybe both you and Mr. Mahan can comment, banks in the EU often complain about heavy regulatory burden, calling for more proportionality, but at such instances as last year, they benefited largely from the strengthening of the overall regulatory framework. So what is your view on that first?
Yeah, thank you. Thank you very much. And first of all, thank you very much for organizing the conference and, of course, for inviting me. It's a pleasure to be here. It's interesting what you say, because you said, what do you think to me as a regulator about the regulation? Obviously, I think it's right. But I'll try to elaborate a little bit more on that. But one moment of particular happiness for me was around last year, when for a period of about 1-2 weeks, around March, April of last year, the banks also thought that the regulation was a good thing, which up until now used to be the other way around. Now, more seriously, I think that signals to something, which is true, that what has been built since the global financial crisis to strengthen the banking system worldwide, around Basel, but not only Basel, resolution, recovery, all these other areas, I think has proven to be useful. Having said that, and I think that the way that it has been implemented in Europe has also proven to be useful, because in Europe has been implemented in 2 particular additions, if I may. One is that we decided to implement the rules across the board of all banks, and there we can have an issue about proportionality and appropriateness of that decision across the different banks in the Union, because we have over 4,500 banks operating in the EU. And the second question is that we also decided to do that at the same time that we change the way in which we do supervision and who does the supervision. We changed the intrusiveness of supervision, and we changed the fact that supervision became supranational, particularly in the euro area, in the hands of the ECB. And I think both of those decisions have proven useful, to be honest. I think they have proven useful. I think that the lessons that were learned from the crisis last year, the first one, and Carmen already said that, is you cannot be complacent. Risks are out there, and they may arise. Having said that, I must say that I am super pleased to see how the economy has evolved over the last 15 months in a period in which most major economies increased interest rates after a decade of such low interest rates. You know, the outcome, I mean, if I were to sign 15 months ago, would you sign for this outcome? I would not doubt. I would say, yes, this is unthinkable. You know, and I'm not saying this because we're sitting here being hosted by a central bank of the ECB. I have next to me a governor of the ECB, you know, the governing council. But I think it's true. The impact of the monetary policy in financial stability so far has been very, very, very limited, and that's a good sign. You know, having said that, and I think we can come back to this as we think about ways forward. You know, what we have done is not finished. You know, the banking union has a lot to progress. Some of the statistics that were put forward here on the role that banks can play, on the role that internationalization can play, is an important aspect that we need to work on. You know, and I think that as we go forward, we need to reflect on just one statistic that I'll give. We've created the institutional framework. We put a single rule book, we put a single supervision, as I said before, but at the same time, the degree of cross-border banking activity in the European Union over the last decade has not increased. And that's a challenge, I think, that we need to reflect upon. Thank you.
Mr. Marhan, maybe a point from the industry.
I mean, Jose Manuel covered everything, as per usual. No, so I don't think there's any debate that Silicon Valley Bank was a failure of regulation, and we have evidence for that, right? So there was a regulatory change in the US when the previous administration came in that explicitly removed marking to market these certain portions of the bonds. I think it was encouraging to see, as Chairman Kampa noted, that the European banking system was resilient both in this crisis and was very resilient also, and perhaps that was the most surprising aspect when Credit Suisse was going down around this time of last year. I think a lot of that is due to regulation and supervision. A lot of that is also due to the fact that we have now had 15 years of de-risking and 15 years of business model change at European banks as well. I think we're coming back to that, so I'll just leave it here.
Thank you. Let us now discuss the role and the development of banking sectors in CESEE region. Banks in Western Europe have a variety of business models and operations, from simple savings banks to sophisticated investment banks or diversified universal banks. It seems that banks in CESEE region are more traditional, so universal banks with narrower business models, and the region, as we have heard already today, though predominantly bank-based, demonstrates low banking penetration as evidenced by banking sector assets to GDP. Let me ask you both, Mr. Vujicic and Mr. Romahan, is my assessment more or less correct? Is this fact due to demand factors, so needs of the customers, or more supply factors, capabilities of the industry? How this structure of the industry serves businesses and citizens? And finally, does the CESEE region lack broader, more diversified banks offerings, or is the current scope and structure of services simply the result of the needs that the region has? Please, yeah.
Maybe I can, but let me first thank for the kind words. It's very nice of you. We really did a very good job, and probably better than anybody expected. I remember when we talked to the industry, to the banks, we have this dialogue with the banking industry regular in the ECB. A year ago, people were talking about the outcome that we see today as a Goldilocks scenario, which will never materialize. And then so many people were talking not only that we will have to bring down the economy into the recession, but also that along the way, something will break. And they will say, we don't know what's going to break, but something will certainly break if you have a 450 basis points interest rate increases, as of today, nothing broke. That doesn't mean that nothing will break in the future, as all supervisors carefully always say, there are always risks around. We have to be careful and aware of them. But so far, so good. Nothing really broke. But that cycle of interest rate hikes has produced something different, which is unique and has never happened before. We hiked at a time when the excess liquidity was such as never previously in the history. And that has created increase in the net interest income of the banks that we have also never seen before. If I look, for example, at the Croatian banks, the share of their interest income in 23 that comes from the central bank is 18%. And even if I look into 24, 25, 26, and I take market pricing of the DFR, I only see that from 24 to 26, that will go down by 33%. So the interest income of the banks will still be very generous in 26 if the market pricing stands where it is, particularly compared to the many years of zero or negative interest rates. So the whole framework has changed, and that's where the profitability of the banks come. But then going back to your question, why didn't we see in the period of very low interest rates more bank lending increase in the share of the? What we saw actually, and this is what was in the presentation, that the thing that puzzles you, is that actually there was an increase, much faster increase of the equity financing. So we see that in the Croatian market than the bank, at the time of the historically lowest interest rates. So that suggests you, probably, I'm not claiming that I know the answer, but that suggests you that there is much of it on the demand side. And that what we see, for example, is that less and less companies are getting leveraged with the banks. So number of companies that don't take loans is continuously increasing. We also see that many of them value the so-called flexibility premium. So they look for different sources of financing, which are not bank financing because they have less strings attached to the financing. And we also see that that is helped by the type of the companies that is growing fastest today. And if I look, for example, at my own country, the fastest growing industry for years now is the IT industry. And these are the guys that are not typically bank clients. And overall, if you have modern companies which have relatively high asset turnover, which have leasing out of the equipment, which have externalization of the services, they will be less in the demand of bank financing than the traditional companies who have it in their DNA. Now we did see two increases in the credit, which were very strong, but were basically anomaly. It's not something which is a part of the trend. One was the COVID, where everybody rushed to build the war chest when they saw what's going on, so the credit growth went up a lot. And the second one was the Russian aggression in Ukraine with the energy prices skyrocketing, where again they needed a lot of working capital because energy prices went up. So again, the credit growth went up a lot. That has distorted also the assessment of the real credit growth, what's going on with the credit growth in terms of the policy response to the interest rates, etc., because these were two unusual situations. But by now, that has petered out. So we are now in a situation where we can more reliably assess the one of the important things for the ECB, of course, is the pass-through of the interest rates on the credit market. But then, if you look at, I'll finish with that. If you look at this pass-through, the interesting thing is that this has been very different across the Eurozone. Why? On new loans, it has been quite harmonized. But on the existing loan amount, it really depended whether you have a fixed or flexible exchange interest rates. And you see that in Europe, you have very, very different culture of the financial banking markets. In some countries, everything's flexible. In other countries, everything's fixed. So the pass-through, of course, is very different in different areas because of that. So this is something also from the perspective of the ECB, for a policymaker, that we should take into account. And of course, from our perspective, it would be better that you have a same pass-through through the Eurozone than you have everything flexible in Baltics and looking at Martins, or you have everything fixed in France, in Germany, or Croatia, where we have 80% of the fixed market. So that's also something that we'll have to somehow work on, and it's difficult to expect that this will happen without the banking union, really. And then okay, I'll stop here and then we'll talk about that.
Mr. Omahan, sitting in one of the biggest financial cities in the world, how do you see development of banking sector, the structure, the services in the CESEE region compared to, let's say, well-developed financial markets?
So, listen, I've been taking notes when the IMF colleague was giving the presentation, and I'd like to change the narrative a little bit here. And I'd like to start by saying that the Central Eastern European banking systems have come an incredible way over the last 30 years, and I think that you have an enormous amount to be proud of. And I'm not just saying that because I'm originally from Slovenia and from the region. I'm saying that because of three very basic things, and I'm going to try and contrast this a little bit with what we see in more Western parts of the European Union, right? So firstly, the Central and Eastern European banking systems are very robust. They're robust on a standalone basis. They're particularly robust comparatively, and I'll explain what I mean by that. I think, secondly, they're profitable, and that's no bad thing. That is your first line of defense for any financial stability shock, and it's certainly helpful in times of crisis. And thirdly, the structure of the market is such that it pretty much guarantees reasonable levels of profitability in the future as well, which is certainly something we cannot say for a lot of West European banking markets, particularly the largest West European banking markets, right? So let's take this in turn. The Central Eastern European banking systems are robust. Okay, we have had pretty much 15 years of persistent financial shocks. So in September 2007, Northern Rock goes bankrupt, and we kick off the global financial crisis. 2007, 2008, 2009, some of the largest and most respected financial institutions in the world collapse. Central Eastern Europe basically unaffected during that period of time. Obviously affected from an economic shock perspective, but banks are solid, banks are stable, banks are actually profitable throughout that period, right? Then we have the European sovereign crisis, where I had the opportunity to meet Jose Manuel very closely during that period. So we have 2011 and 12, sovereign crisis accompanied by real estate shocks in some of the largest European countries. And again, with some exceptions, and Slovenia being one of those exceptions, but with some exceptions, the Central Eastern European markets did pretty well during that period too, particularly on a comparative basis. No large-scale bailouts, no large-scale liquidations of institutions, no forced mergers, right? And then we roll the clock forward into this period that we have for the last 7-8 years, which is the period of supervisory and regulatory adjustment that Chairman Kampa was describing before. The adjustment in Central and Eastern Europe was minor compared to everybody else. The entities that had to adjust the most were some of the biggest and most esteemed institutions that you have in Europe. And obviously then, and this applies for all of the European financial system, and I agree with the previous assessments of the other speakers that when it came to the global economic shock due to the health crisis, that the European system as a whole handled this incredibly well. So I think this would kind of be the opening narrative, that the Central and Eastern European banking markets are robust, they're profitable, and they have structurally they are structurally such that you have profitability in the future. And then, you know, just to make sure we don't take too long to answer these questions, because they're big questions. You know, on your point on product offerings of European banks and how that compares to Central and Eastern Europe. So European banking in the modern sense of the world started in the early 90s. So we basically had 35 years. So that's a very short period of time. I would have agreed with the statement that the product offering was lagging 30 years ago, 20 years ago, maybe even 15 years ago. From a market's perspective, from a practitioner's perspective, these banking systems now, or the bank business models, are very similar to other domestic banks, right? So if you look at Central Eastern European banks, you compare them to the Nordics, you compare them to the Swedish institutions, these are very similar banks, even to the domestic Spaniards. I mean, there isn't that much difference. If you want a full product suite, and what by that I mean retail, commercial, investment banking, there's 5-6 banks in Europe that do that. So that's not a question of where you bank, that is an individual strategy, business model decision by an institution. And these banks are Deutsche in Germany, BNP in France. After that, we are already in Switzerland with UBS and in the UK with Barclays, right? And there are, obviously then you have the Americans that do just that in the European context. So, but I think it's very important, you know, to not say, so as a practitioner, as a market-facing person, you know, the general attractiveness as an investment proposition, as a stable investment proposition of Central and Eastern European banks is very high. And you see this in valuations. You know, the Polish banks or OTP, in Hungary even, these institutions trade at substantial premiums to the likes of BNP or even Santander, for example, right?
Okay, so we have excellent profitability, a lot of potential from the banking side. OECD recently published Global Debt Report and Global Corporate Sustainability Report. Mr. De Moya, what do your analysis show about the borrowing capacity of the companies, this time we talk about companies, in the CESEE region? Relative to GDP, their exposure to banks, as we have seen, is moderate or rather low, while in relation to capital, they seem to have less room for taking out additional debt. What is your take on that?
No, thank you. And okay, in general, I would say, and then going to CESEE region, I would say, I mean, I like debt and I like bonds. I mean, after the global financial crisis of 2008, we have had an amazing expansion of bond issuances, so securitized, I would say, debt, which is, I mean, has also important and positive aspects. Lower, I would say, even, let's say, rated governments and riskier companies enter the market. And we need financing for these companies and, as we saw, in particular sectors. So this is good. And it's also a good, there was some mention of financial education and financial inclusion. Markets are made by supply and demand. So it's also a good, important asset class for investors to be held directly or indirectly. So this is, and also obviously less, I would say, reliance on the traditional loans. But when we look at the CESEE, the region, I mean, three things are evident, and Jason also presentation and Alpha at the beginning is clear. I mean, that there is I mean, access to finance in general may be an issue for companies, okay. There is room for further, I would say, penetration of the traditional banking sector. And corporations, this is a fact, are underdeveloped, and I look at Peter, are not so much served by capital markets. So I would say the answer to the question is that, okay, they are, I would say there is a need of financing which is not, cannot be, you know, completely satisfied by market. And again, and companies also, these are research, they do have a room here to increase their debt and their long-term debt, which is important also to expand in, to invest in innovation and expanding their business. Now, 4 simple data that do have, I would say, complementary also, Jason, to yours. I mean, one, I mean, but in a sense you should also differ in a different way. So bank credit to non-financial corporation in CESEE economies is really a very relative low share of GDP. 47%, okay, there is a peak of 67% in Slovak Republic, but there is 78% in the EU. And actually, if we exclude Russia from 47%, is 39%. So basically, it's half of what we see in the EU. Second data is low banking penetration. Obviously, you can see it from the other side, what we see in the corporate balance sheet. And almost half of the unlisted companies in the region, and they are basically SMEs, they have basically no debt. you see no debt in the balance sheet, half of them. And the other 25%, 24%, they really have a very low leverage, traditional leverage, so less than 20%. And this is also why then aggregate levels are much lower, 15% than in EU. And for those who that have debt, basically this is not long-term debt, but we need, again, long-term debt to finance in particular, in particular sectors. So we need to extend maturities. And the last thing in terms of data, simple of capital markets, they play a limited role. If you take simply market-based financing, so basically the total market cap of non-financial companies plus the outstanding debt in the region, non-financial corporate debt. This is only 21% of the region GDP, in contrast to 64% in the EU, and as we know, EU is not the super champion of capital markets, and all over the world is more than 110%. And by the way, excluding Russia is 14%, so it's very, very low. And again, just to conclude, so we need well-developed capital markets because this is important. We have seen, okay, the financing even of the historical, telecommunication railway, but also more recent times. And we saw it on the pandemic. I mean, you remember, basically, the companies tapped, the market, both equity and bonds, really during the pandemic. This was important. I remember with some of you, the dramatic days, hours. I was a commissioner, an Italian commission of, there was the fuss of saying that we should close stock exchanges. We had these dramatic. Actually, obviously, we kept them open, and it was really very important for companies to go there. So this is, I think, essential, and so that's why I think it was also mentioned. We need, on the one side, stronger development of regional markets, but then also stronger, I would say, development with an integration, I would say, EU, Euro area, EU, but also international, and this is also the object of many projects that we have seen in these also weeks of advancing with the capital markets, with the S, not capital markets union.
Thank you. Mr. Maher was very positive on the structure and the services of banking sector in our region, and my personal thinking is also that we have done a lot in last 20, 30 years from the point of view of the development of banking sector, from the point of view of regulation, and all the things that we have done in the context of European Union and Eurozone and common institutions and so on and so on. But I still feel when looking back 20, 30 years ago in Slovenia and other countries in CESEE region that foreign banks with the knowledge and good practices and so on have helped in the development of banking sector in Slovenia, in the region. I mean, Mr. Vučić, Croatia has adopted euro in the beginning of the last year, and with that you have joined the common institutions of the eurozone. Nonetheless, even before, foreign banks have been widely present in Croatia. And here I have a couple of questions, and you might touch upon a couple of them. I'm wondering, how do you see these institutions coming from abroad or from Eurozone? What role do they play in the national economy? How do they fit? How do they fit in the economy? How do they, let's say, enhance competition? And how do they react in times of crisis? For example, in 2008. How do they fit with risk appetite in profit distribution? How relevant is the country of origin? I mean, if the mother bank comes from Eurozone, where SSM works, or out of the Eurozone, and more maybe for the last question, which is more provocative, what do you think, does a country need a strong bank in domestic ownership from the point of view of, let's say, national importance and pride?
Yeah, pretty much. You're absolutely right. We have the tradition of the foreign banks, like almost all countries in Central and East Europe, even from way before we entered the Eurozone. It's just that the supervision and the resolution framework has changed since we entered into the Eurozone, or better to say, into the close cooperation before even getting into the Eurozone. What's the role or experience with the foreign banks? I would say the very positive one. If you go back to the times when they entered the market, and these were the 90s, after the beginning of the transition, it was a great opportunity for them. So whoever did it was very smart, I think. And some didn't. I don't think they were that smart. I talked at that time with both bankers and those that saw it as an opportunity. Certainly made a much better a move. If for no other reason, as was said before, if you look at the valuations of the Central and East European banks, are much better than the valuations of those banks that at that time were telling me, oh, that it doesn't make sense to enter into the Central and East Europe, that they can only open the representative office and do some large corporates, and the rest is not worth looking at. But then when you look at what happened was in the old times, you had the old banks, of which many were bankrupt, basically, after the beginning of the transition. So they were targets for takeover. Some were not. And in our case, we had a two-tier banking system, even during the Yugoslavia. They have had their retail segment and their corporate segment. But you can say that the corporate segment was not really fully market-based in terms of the relationship with the companies to which they were lending. So there was a great space for the improvement, moving to a modern market-based banking system. However, the largest growth opportunity was actually in the retail, which was unsaturated and very potential market with the high margins, and that's where most of the money flew in. And that was, I would say, in 90s was good. In 2000s, ceased to be good, and we got worried because the rates of growth of credit were just too high. I remember when in 2002, 3, 4, we were looking at the credit growth, and here we're talking about lack of the credit growth. I'm going back 20 years. There was too much credit growth then. And we were looking at the rates of growth of credit of 20%, 22, 23%. Of course, for a monetary policy maker and the supervisor in the same shoes without the Chinese wall in that sense, it's very difficult to estimate what's the natural rate of growth of credit, let me call it that way. Huh? But we were sure that 22 or 3% is not. So we then deployed a host of macroprudential tools to stop lending, including very high reserve requirements, marginal reserve requirements on additional lending. You extend the loan, you pay additional reserve requirement, up to the basically outright tax on a credit growth, where we said that if the bank grows credit more than 12% a year for any euro of additional lending, they have to buy the central bank bills, which yielded 0%. So that was the time of 2000. So you have 90s when the banks ended, then you have the 2000s excessive credit growth. And it's good that we did that, because we really, that slowed down the credit growth into the financial crisis, which started in 2008. Having not done that, I mean, the price that to be paid would have been much higher in 2008 and 2009. Now, then comes the 2008, 2009, with a very high loan-to-deposit ratios of foreign banks. And that's where we set up a Vienna initiative in order to coordinate things, in order to prevent the disorderly deleveraging of foreign banks from the Central and East Europe. And it works. So, my assessment would have been different if it had not worked, but it worked. It was a kind of a coordination problem where somebody should have agreed that nobody runs towards the door, because if everybody runs towards the door, not everybody can get out, at least without the significant losses. And that's where also the IFIs played a very useful role, the IMF, the EBRD at that time, EIB, World Bank, Commission was around the table. Not the ECB at that time, yeah, directly, but indirectly. And then we weathered that problem of the financial crisis, and landscape completely changed. No? Because if you look at the loan-to-deposit ratios today, compared where they were 15 years ago, it's a completely different world. And obviously that answers also to a large extent your question whether the banks are in a good position to lend. They are. They have a lot of capital, they have loan-to-deposit ratios which are very favorable, they have a low cost-income ratio, so they can lend. There's no problem. Of course, this is also one thing that we discussed with the banks post the GFC, where it was clear that you have to increase the capital requirements. And then I remember those discussions, many banks cried, no, if you increase too much capital requirements, you'll see a drop in lending. We won't be able to lend. In reality, it's just the opposite. Well-capitalized banks can lend. Those with a low capital, they don't lend. And if you look cross-section time series, European banks, you'll always find the same conclusion. Better capitalized they are, more willing and more able to lend they will be. So in Central East Europe, again, going back now to these days, and it has been said that you can see it also through the valuations, banking market is healthy, well capitalized, quite efficient with relatively low cost to income ratios, and the valuations are higher than they are of the peers, although we've seen now the valuations going up from 0.5 to 0.8% price to book. However, I mean, this is on the wave of this profitability that comes from risk-free assets that the banks keep on the balance sheet of the ECB. To a large extent, the structural problems, why the banks are still poorly valued in the markets, stay there. And this is like a fact that they operate in a low-growth market. Europe is a low-growth market if you compare it to the US. They operate in the fragmented market, where they cannot really, except for the Central East Europe. The rest of the Europe is, and going, now I'll get to your question whether you need national champions, is still protected, and you cannot grow your business, while the American banks can do business in the whole US market. They also operate in an overbanked market. It's clear that we have still overbanked market in Europe. They operate in a market where investor is not sure when bank runs a high profit whether it's going to be taxed. And that's another fragmentation in Europe, because it depends in which jurisdiction you are operating. That determines whether your profit will be taxed or will not be taxed. And it's difficult to see that ex ante, you look at some past behavior, whatever, but for investors it's also not very acceptable thing. Regulation itself, I'm not sure. I had a discussion, we had a Euro 50 group meeting in Siena last weekend, and I was asked by some of my French colleagues, Lorenzo and Klein, said, tell me what over-regulation is really preventing you. It's much more these other things, and also sometimes management of the banks. Don't forget, companies are also evaluated on the basis of the management. Management is important. And some banks are better managed than the others. You have been mentioning the SVB, but look at the Credit Suisse. That's a typical management huge management failure, which was not addressed by the supervisors. The bank went down with a cost-income ratio of 111%. How does you run a bank with a long-term overhead? So it's basically burning money of investors. And then somebody goes to the TV and says, I'm not going to invest into that bank, which has 111% cost-to-income ratio. And then people attack that, the guy who said that, instead of the management that was burning the investors' money. So it's also that. And it could be also that, you know, I'm long in the business, so I remember people from different asset management investors sides who were long in the European banks at different points in time, because they said this is cheap. They went long, they're not in job anymore. That also affects a little bit the dynamics. Do you need a national champion? I don't think so. I think that the feeling that you need a national champion is to a large extent preventing the development of the banking market in Europe. And as soon as we get rid of that idea, the better it will be for deepening of the banking union. And also the same thing pertains to the development of the capital markets union, where after sitting so long around the table and listening to all the discussions, I now personally think that insisting on harmonization of the insolvency and tax systems, which was in one of those slides, is a wishful thinking. So it's probably better to try to build a 28th system instead of trying to harmonize 27. We have the European Court, we have ESMA, we need legislation, and let's build a 28th pillar, and whoever wants to go there can go there, list. Let's do the European London in terms of the capital markets, rather than trying to harmonize 27, which will not happen anytime soon.
Interesting thought. Before going to the future, I have one question regarding the non-bank lending. Mr. De Moya, what is your view on the expansion of this? You have touched a little bit on that, but still, on the expansion of non-bank lending, a phenomena that in recent years also is observed in several CESEE countries. What factors what are the contributing factors, and what measures can be taken to mitigate associated risks?
Oh, thank you. And this was also in part one of the last points of Alfred's presentation, talking then about private equity. I think in general, I think non-bank, lending and non-bank financial institutions, they play, an important role, and they can play, and is also, I would say, could be even a healthy competition with traditional, banking sector. I mean, all over the world now we have that basically non-bank financial institution assets are more or less half of the total, financial assets in the world, to 220 trillion around. Now, we have seen, so simply in the region here, we have seen that due to some also, I would say, it's through the role we can discuss banks here, profitable role of foreign banks. But okay, there is an increasing, I would say, appetite and demand also for of companies, and then of more, credit, and also I would say more a positive attitude also of, let's say, consumers, investors, curiosity maybe, because then again, we need financial education to have more financial inclusion. So this is the framework. Now, in terms of, but then of data also, and also our research, but still also the non-bank lending part is would say, remains limited. And depending also here maybe on some other fragmentation, which I would say, but this is a broader point, not necessarily of regulation, but really of attitude and of supervision. But this is also another issue we could discuss. For example, okay, we have some interesting examples. Asset managers in Poland and Czech Republic have assets exceeding 50 billion euros each, which is one of the part. We know that all over the world a big expansion of the non-bank financial assets intermediation came from institutional investors. And this is large with respect to the region, but it's still very, very low compared even to Europe, which again is not the best in class. Private equity firms who also engage in private lending raised 16.2 billion euros in CESEE countries basically in 15 years, this only represents 1% of funds raised in Europe over the same period. Now, the topic is that, as also you were asking, now the diversification of, I would say, credit supply in general, away from the banking sector, this is, I would say, all over the world, and here as a complementary, is positive, I think. But obviously there are issues that we should be careful. I would say some of them are already there, some are more structural. First, I would say obviously economic downturn could increase obviously credit risk due to higher funding costs and defaults. And again, in our debt report, we have also done some sensitivity analysis. More broadly, we have a lot of funds enter the market, again, good way for investors to indirectly participate. A lot investing in bonds, but actually in investment grade, but then investing a lot of, given that we have on the market a lot of companies really borderline, if you may have a small downgrade, this can create, it's an issue. Secondly, obviously, a fall in asset prices. This is normal in many of institutional investors may also cause margin calls and others, and we have seen also during the crash. So this can be an issue. And then obviously liquidity risk. The third point is always there, and this can be cyclically affected also by uncertain, I would say, monetary conditions, but also maybe a different perception of the announcement of different central banks in the world, but actually here in the region, this is more homogeneous, at least for euro area CESEE countries. Then there are structural changes which are and risks that should be tackled. Again, some of them are very much linked, because typically, I would say liquidity mismatch and maturity transformation is an issue, and is obviously different from the traditional maybe banking part, but again, this is also structurally. Excessive leverage also tends to increase both then credit and liquidity risk. And here maybe is an issue, because we talk about non-bank financial assets and intermediation, but what is bank and what is non-bank? What is really we see is that we have huge, banks own insurance on banks, big asset managers. I would say maybe the more insulated sector could be really the private equity, where we see less, I would say, ownership, concentration. So this is an issue. So what is needed, I think, is really close monitoring. Again, it's I would say entity-based and activity-based, irrespective of the legal nature of entities. And this is also, we see also in Europe, Jose Manuel, typically the important, I would say, both in terms of regulation and documents, but then in terms of supervision, are, if we think about ESAs, it's all the joint, I would say, committee, cross ESAs, because the topic that also of the last slide, the digitization, are all cross. And, but also we need, I think, better improving and more disclosure in metrics. So also developing, better metrics, I would say, both in terms of supervision, but also in terms of acting, and then analyzing where you can expand. And so flexible, I would say, attitude for continuous development. But I'll stop here.
Thank you. You have touched upon some questions that I have for the future. And if you try to look what's lying ahead of us, let's try to think out of the box, and let's imagine that we have a crystal ball. And these questions are for all of you, if somebody wants to answer them. So, what can we expect in the future? So, how can new technologies, digitalization, disruptive innovation, new technologies, how can they reshape traditional business models and processes? How does regulation and supervisors fit to that? What are, let's say, the biggest risks for the future? So, what is laying ahead of us? And we'll just start with Mr. Kampa.
Thank you. It's not very easy to answer from a regulator's perspective about the future, because that's really the job of entrepreneurs and visionaries, not of regulators. But I'll try to reflect on it. I mean, from the regulatory point of view. I mean, when we think about this problem, we always say, I always say the same thing. It's like, innovation, once it's created, you cannot pretend it doesn't exist. You cannot just ignore it. It's there. So what you need to do is you need to try to assess, from our perspective, what are the sort of like opportunities, but that's more for the, as I said before, for the entrepreneurs, but particularly from our perspective, what are the potential risks? And as we think about those risks and try to sort of put some guardrails of what's first idiosyncratic risk that a particular company runs, well, that's their problem, versus somewhat more systemic risks that may affect the system more widely, and try to put boundaries to make sure that those systemic risks don't occur. Now, as we go through that, I would say two things. First is we should try to be neutral. And by neutral, that means neutral to a technology that comes into place and who brings that technology, whether it's a new player or it's an existing player, so that we don't become either implicitly or explicitly through the regulation, so like the determinants on who is the winner, on who is the winner in that situation. That should be the competitive dynamics that drive that decision. And I think that's easier said than done, to be honest. But I think as a goal, it's probably an appropriate goal. The second aspect, which I think I'm more constructive on this, when I think about the banking industry in particular, I think that the banking industry will have a good ability to integrate those technologies. Traditionally, they have been good at integrating technologies overall, but at the same time, the technology should be disruptive. It should help us to create a better banking industry. It should help us to create a system in which we have good firms succeeding and bad firms exiting out. And that's what the neutrality I talked about before as a first principle is very important. But we should not be afraid the banks disappear. I mean, banks, individual banks, even I don't think the banking activity will disappear, but we should not be afraid. We should be concerned that potential disruption leads to financial instability, and make sure we have the proper tools to allow that, disappearance of those poor performance and the entrance of new performers. I'll give you one example of what do I mean by this, in which I've been surprised, and we've been surprised at the ABA. We discussed a lot, and pretty much you are in our board, which is we were expecting that with digitalization, as the interest rates will rise, we will see more active competition for deposits and probably higher price sensitivity to deposits across the union. But that's something that has not really materialized significantly yet over the last year and a half. And that's a little bit of a surprise for us. We would think, or for me at least, I would think that there would be a channel for competition there. And that's not necessarily bad in itself. That's a good mechanism, I would expect that over the last 5 years, when I joined the ABA, there was a lot of talk about fintechs, a lot of concerns about fintechs. Over these 5 years, we have fintechs were going to destroy banks. Now, 4 years down the road, I think the consensus was like fintechs are actively collaborating with the banking industry to shape the industry. Another concern is about big techs. I think that they're going to come and destroy it. Maybe, I don't know, that will happen, but we will see. As I said before, from our perspective, we should make sure that financial stability gets preserved and that good services are provided to customers.
Let's hear about this from the industry perspective, Mr. O'Mahan.
So, there's some questions that were tackled before that I'd really like to address if we have some time.
Please.
Maybe a bit later. It is amazing that fintech has made no inroads into banking. There has been no impact. Look at any other industry, look at retail. And what Amazon has done to retail. Just go down the list, and then you will see an industry which has incumbents which struggle to make a 10% return in many cases. So I'm talking about the European banks industry, that are wounded, that are convulsing, that are inefficient, that employ hundreds of thousands of people, and there is no effect that the fintech industry has had so far. There are two exceptions. One is payments, and the other one's asset management / private wealth. And the reason why that has been a success is that those two subsegments are not regulated. And I think there was a question before, Primož, that you asked, which I thought was an excellent question, addressed to all of us, but none of us really addressed it, which was banks complain a lot about regulation. They do. But there's benefits to being highly regulated, which is new entrants either don't want to enter into a regulated sector or find it too complicated to enter into a regulated sector. So what is a pain most of the time acts as a moat, as a protection when it comes to external competition, right? And I'll give you an example here. I had a conversation with the chairman of one of the large Spanish banks, actually, of all people, and a question came up, which is, are you concerned that Google or Amazon will enter banking, mainstream banking? And the answer was no, absolutely not, because I think these are highly intelligent people that do not want to go from trading on a 40 times multiple to trading on a 6 times earnings multiple, right? And then the issue I wanted to address, and I think, you asked about the future of banking. So the operating future of banking in Europe is very bright. Yeah, and this is controversial. The governor here has friends that have invested in European banks and done badly for a long period of time. I think they're probably going to do well going forward. And the reason why I say this is that European banks' valuations were depressed for 3 main reasons, all of which are now changed. They have inflected and they've changed. The first reason was that the shareholders kept getting diluted for different reasons. So you bought a share in a European bank, but you didn't really know how many shares you had, because either banks had to issue capital to cover losses, or Jose Manuel and his colleagues came up with new regulation for which you needed capital and you diluted shareholders, et cetera, but that's over. I mean, I think we agree probably even on regulatory side, things are pretty much settled. The second reason why banks did poorly is that they had to de-risk. There was a colleague from the IMF before showing what looked like a surprising chart, which is that the non-performing loan ratios keep trending downwards. Of course they do. We have had 15 years of de-risking. These institutions are not the same institutions that they were in 08, 09, even 11, 12, or even 14, 15. They're safer institutions. There's a different debate, which is where the risk is. We touched upon private equity. We didn't talk about private credit, which is where I would argue a lot of it is. But that's gone too. And the third one is margins. And yes, margins are going down, but they're not going negative. I remember in 2015, or was it 14, when President Draghi announced that the ECB is launching a temporary measure of cutting rates to negative, and it's going to be very short-lived, and we lived with it for 7 years. And at the last one, I'll be really brief now, because I know, but it's a sensitive topic here in Slovenia, particularly, which is, should countries have their own banks? Their own banks. What does that mean? All right, what does that mean? So is UniCredit an Italian bank? Is it? It's an Italian bank. In the top 10 shareholders of UniCredit, there's no Italians. 0. There's 1 European, which is Norges, and 9 American institutions. And they own more than 30% of the capital of UniCredit. The largest shareholder of BNP is the Belgian government, and then a whole long list of US institutions. This is why the need to develop the European capital markets and the capital markets union, as you pointed out, is so urgent. Because this is how you keep, if you want, an industry domestic. You have to create pools of capital which are able to hold this on a long-term basis. And what's really dangerous, in Europe in particular, is that typically when the question is asked, well, should these banks stay owned locally, it's not really a question of whether we want domestic owners or foreign owners. It very quickly morphs into a question of whether we want private ownership or public ownership. And this is where the problems usually come from. Anyway, so in future, what's the future? Operationally pretty good, I think, particularly compared to the last 15 years. From a market structure perspective, if this process is complete, the bank union in particular, you're going to have fewer banks and bigger. And we're going to stop asking the question of, is this bank owned by an Italian investor? And I think that the notion of being European will displace it. On the fintech, I don't see it, but I was late to start using the iPhone, and I used the BlackBerry up until 3 years ago, and all these things.
Thank you very much, Mr. Vucic. Do you have a short thought on that? On the whole thing, on the future, yeah.
on the monologue.
Let me go to your question on the innovations, disruptive technologies. You'll remember that Bill Gates, when he was CEO of the largest IT company in the world, famously said that we need banking, but we don't need banks anymore. And people took it very seriously. They thought it's the end of the banks, that the big tech will take over. And yeah, I remember even before that, in the BIS, that we had the discussions, that was about the time when the credit growth was too high in Central and East Europe, that telecoms will take over, because they have this large client base, they will provide us, that the banks will be gone. None of that has happened, nor I think that we will see the disappearance of the banks. I agree, as it was said, the people who come from a tech side, they go only up to the point when they don't need to get into the regulation that we developed for the deposit-taking institutions. So they don't want deposits, because then they step into this regulatory arena in which they don't want to be. So the banks, basically, except in the payment system, yeah. But what banks have been doing traditionally is banks have not been very innovative. Banks have this old type of business which worked in same framework with same principles for centuries, I would say. What they do is they use innovations to upgrade their business. And that's what they have been doing all along, and that's what they will continue to do. If you think about the banks, the innovations, in the 80s you had a home banking in the US, launched by one bank, what was it, Union Bank of America or whatever. But they did not innovate in a sense that they developed the technology. They started to use existing emerging technology, that was the internet, to provide their clients better service. And they keep on doing that. The banks have not invented the smartphones, but basically what you do the banking now from the smartphone. You don't go to the branch, but somebody else has invented the internet, somebody else has invented the smartphone. What the banks do, they piggyback on these innovations and they improve their services. And I'm sure that with the AI it will be the same. They already use it in the same way. They improve their services. There's a huge potential in AI to improve what the banks are already doing, but the banking model it's been for centuries the same. It will stay the same. It will just be better, because the AI obviously allows you different things from onboarding clients online, better AML, the decision making in the end. Although the decision making will never be made by the machines, I'm sure.
Hopefully.
Maybe in the retail segment, okay? When it comes to the really important decisions, you cannot have an AI bank, where you don't have the management board, you just have an AI system, and then we were joking, you someday, the shareholders get the email from the AI bank and says, look, because the, I don't know, dollar-euro exchange rate deviated more than 8 standard deviations, which is what we accept as a possibility. The bank cannot operate within the remits of the given parameters, and it's under the liquidation from 3 p.m. So for any inconvenience that might cause to you. So the problem is that I spent some of my career programming in the IBM. At that time it was called the Les Systèmes Experts, expert systems. IBM Watson, working on that. So any kind of the AI task that you give, you have to bound it by the standard deviations. Otherwise, you use too much processing power to solve problems that will never happen, and it leads nowhere. And in the real life, sometimes you will always get out of the 4 standard deviations, 6 or 8 standard deviations, and AI will not be able to manage that. But it will help you a lot, because it can process data much better than anything that we had before. Although even there, the question is, for example, when it comes to the credit scoring, credit worthiness assessments, etc., whether you at some point just move into the over-parameterization. You include 10 variables, then 100, then I can help you crank to 1,000, 10,000, but then you get too much noise. You don't know what you're doing. So you go back to the simpler system because it tells you more about the credit worthiness. I was talking recently in Hong Kong with the Chinese banks that are using a lot of AI now to try to do the credit risk assessment. And basically, that's also what they concluded. You go too far, you get over-parameterization, you don't know, but there's too much noise, so the model does not help you anymore. So that also has some limits. But yes, the new technological innovations will make the banking that we have better banking in the future, but with banks, not without the banks.
Okay, Mr. De Nooijen, just final short thoughts because we want to leave some room for the questions, please.
Just on AI simply, and we're working a lot on these. We're having a big, some of you will be there, a big event next week with the FSB. But there are big opportunities, and we see already examples in credit worthiness. People that, and again, do not have a credit history, they may have access, to loans. You may have much less bias. Now, just one quick comment on bank. It's true, UniCredit area, we have a lot of, foreign press, but we do not have a real branchification in the EU. So until we have that, really we have banks that can really operate in markets without necessarily having a subsidiary, but only with branch, then you are not going to have any true capital, banking union. We're talking a lot about deposit, but this is, I think, the big issue. And
by the way, you are 100% correct. Yeah. So until you can raise a deposit where it's cheap and lend it out where it's expensive, you will not have a functioning bank union. Yeah.
And so this is. But okay, I have other comments, but I stop here.
Okay, thank you very much. So we have finished our roundtable, but we are open for your questions. A couple of them before we go to the break.
Zadravec, Banking Association of Slovenia. Thank you for the great discussion. I have a question or two for all of you, but particularly maybe for Mr. Kampa and Mr. Omahan, sorry. Some of you mentioned already in the discussion the market price of the shares of the European banks versus their book value in comparison with the United States banks. I'm not aware of how pricing is fitting in Asian markets. And Governor Vujicic also has mentioned that one of the reasons may be uncertainty in the tax environment in which the European banks are functioning. And Mr. Omahan has mentioned some reasons for the past period of 15 years. Now, the question is the following. We have banking system that has great capital adequacy, super liquidity, great regulation, is subject to great regulation. And then yet it's also very profitable for a while already, especially this year. And then yet we are still witnessing that the market price is much below the nominal value of the shares of the banking system. How do you see the reasons now, today, and what do you think shall be done that this robustness and profitability would be in the future reflected in the price of the bank's shares? Don't you see this as a question of concern for the financial stability and also negative impact on the economic development because of the structure of investors as well? It was mentioned that important part of investors are non-European owners of the banking system. So this is, basically the question for the future.
Thank you, Mrs. Zdravec. I think the remaining questions will have to remain for the break. But Mr. Kamp and Mr. Omahan, briefly.
Yeah, I mean, I'll leave it to Jagger to give us the view on why the market is apparently underpricing. Just a couple of three thoughts from my side. First, one is the comparison to the US. That's true. You know, there's certainly a difference in valuation. That partially reflects also the equity markets in Europe versus the equity markets in the US. It's not specific to banking sector only. I think applies to a large number of corporate sectors and publicly traded companies. That's one aspect. The second one, which I think it's important, what does it make you feel comfortable? And I always say the same thing. You know, I think as a regulator that has a concern about financial stability of an industry, you know, I don't think we should feel very comfortable that you're regulating an industry in which the market tells you they're not willing to invest on it, basically. And that's a concern. You know, I think that's a concern for us. You know, I think that having a healthy industry that's attractive for regulators, it's important. Then the third aspect, you know, we tend to think that a lot of the regulation and all this areas, and I think Jeremy pointed to this a little bit, supposedly has made the system more stable, so therefore that should have been reflected in a lower cost of equity. Yeah. And however, what the valuations indicate is that the cost of equity, and what we hear from banks, continues to go up. I believe it has gone up by a lot. There's certainly the risk premium relative to the risk-free rate. The equity premium on banks is very, very large, difficult to justify.
Yeah. So, I mean, it's an excellent question, but it's a question that would require, I think, its own session. So I'm going to do a couple of points very, very quickly. And also put yourself in the shoes of an investor into European banks. So let's say you start investing in 2007. You're a bit unlucky on the timing, right? So just when the fireworks kick off. You would have gotten diluted, and that means the share count would increase of what you bought every single year for 10 years sequentially. So the value or the proportion of the stake that you bought would decline for different reasons for 10 years. That's point number one. Point number two, regulation, credit rating agencies, and bank management themselves de-risked their business models for 15 years. So if the external dilution reduces your return and therefore attractiveness to investors, internal dilution, de-risking, reduces your return. Long term, that should increase the attractiveness to investors, but long term in banking, you know, it's a subjective thing. And then the third thing you had a decade of near zero or negative interest rates, which is now ending. And this is the point that I made before, that from an operating perspective, you had these three mega trends that lasted for more than a decade, that each of them separately inflected over the course of, troughed over the course of the last 3 years, and inflected over the course of the past 2. And it's really difficult to imagine, and you know, judging from the presentations we had initially, the tone of our conversations and the tone of the question, we're all still in this post-traumatic stress disorder period where everybody's expecting the next thing to blow up. And I think it's difficult to take the view that actually, you know, we have had 15 years of de-risking, of issuing capital, and that the system is safer. So that's point one. Point two, the governor made that point before, and I cannot stress how important this point is from an investor's perspective. So put yourself again in the shoes of that investor who's been really struggling to invest in European banks because there's a capital increase left, right, and center every day. Banks need to shed assets to meet new rules. Rates are negative, margins are shrinking, and then you have one good year, right? So this was 2021. You have one good year, and you make a 15% return, which sounds like a lot by historic standards, but it's actually not. Yeah. And immediately, the governments move in and say, actually, you as an investor, what you thought was yours is actually not. We're going to take some of that. That is hugely problematic if you want to position yourself as a credible investment opportunity, right? And then finally, and here I'm going to be a bit critical of regulation, but Jose Manuel knows my view on this very well anyway. Put yourself in the shoes of that investor again and roll the clock back to 2020. So we have COVID, the public health crisis hits, everybody stays home. At that point in time, the European supervisor did something which in my view was wrong, in the market's view was clearly wrong, and we're going to live with the consequences of that for many, many years. as the only major supervisor in the West. So the Fed, the UK central bank, the Swiss regulator. The ECB at that point in time decided to cut all dividends and capital distributions to zero, right? So you are an investor, you've put your capital at risk, but all of a sudden you're told, you know, it doesn't matter if that bank is good or bad, has capital, doesn't have capital, makes money, doesn't make money, nobody pay anything. That decision, you know, compounded with the tax risk on your dividends and profits, has made European banks, from a comparative perspective to the US and the UK and the Swiss, a less attractive proposition. We're gonna live with consequences as an investor. You're gonna live with consequences of that for a substantial period of time. There you go.
Okay, let's leave it at this point. I will thank all of you for lovely discussion, and I thank you for the attendance. Thank you. Thank you.
Welcome also on my behalf. I'm in the Republic of Slovenia responsible for the state of the government bonds market. I'm privileged to have opportunity to first announce the second panel of this conference, financing of capital and business projects through capital markets and non-bank financial sector in the CESEE region. The objective of this panel is to examine how financial markets could be, with huge upside potential unlocked to ease the funding constraints of, above all, innovative projects, and to add or deliver on the growth agenda. The panelists, the esteemed panelists, will be invited to present their views on the state and development of the capital markets in the CESEE region, and to analyze the state and development of capital markets in the region from the point of view of varying levels of development among countries in the region. The ambition of the panel in the second part is to review the regulatory, taxation, legislation, and technology requirements for successful and effective capital markets. We are to discuss the securitization as potential driver of capital markets development, and to discuss or touch upon the role of pension system to play or how this could play in the development of the capital markets. Last not least, we are to discuss the spectacular development of venture capital markets and private equity markets of Estonia. I would like now to invite the panel, the Jeff Gottlieb, to deliver his presentation with the title "Capital Markets in EU CESEE countries." Please.
Okay, thank you very much. It's very good to be here. So I'm the IMF's regional representative. I'm based in Warsaw, where I look at the entire region of Central, Eastern, and Southeastern Europe. And Warsaw is a very good place to be thinking about these issues. It's a large economy in the EU outside of the Eurozone. So in a way, it has the deepest capital markets, and so the challenges that Poland faces are at least as big as the challenges that many other countries in the region face. When I was preparing for this speech, I mentioned to several people in Poland that I was doing it and talking about why capital markets should be deepened in Central and Eastern Europe, and the reactions were interesting. They were quite antagonistic. Two conversations stick out. One is an economist reacted to this by saying, "Why on earth do we need that?" And conversation with non-economists was even more antagonistic, saying, the one sticks out in particular was a journalist, and he said, "I would never put more money into that casino." And I walk away from this conversation thinking, wow, that's a pretty strong reaction. And then my phone buzzes, and it's a screenshot of his wife's stock portfolio showing the losses in the stock market and saying in capital letters, these were supposed to be our best companies. And these conversations remind me of two things. One is that the conversation about growth in capital markets in Central and Eastern Europe is very different than that in Western Europe. In Western Europe, there's a broader sense that there is a structural problem with the growth model and that there needs to be new sources of growth found. In Central and Eastern Europe, setting aside the fact that there's been a cyclical downturn for monetary policy, it's not as much of a discussion that the model is broken. There's concerns about what's happening in Germany, but in general, it's still a high growth region. And so there's a sense that it's not as much of a problem. The conversation with the journalist reminded me of a separate point, which is that the experience with capital markets thus far has not been great, and that there is a lack of trust developed. So the effort to deepen capital markets from here is going to have to overcome trust. So I think that I think this is a good topic to have, a good topic to be discussing today. We have an excellent panel that looks at a lot more of the technical issues of capital markets. So what I'll aim to do is to set up their conversation, albeit from more of a macroeconomic perspective. So I aim to do three things. First, talk a little bit about how firms are currently funding themselves in the region. Second of all, talk about what we see as the motivation for changing the financial model. And finally, and most interesting, talk about the policy challenges and trade-offs. So this is an index that we created on financial market depth. Several institutions have them. This is a sub-component, which is basically stock plus corporate bond market capitalization. So it's a time series over time. And what you see is that the developments in the region, albeit at a different level, follow much of what has been seen globally, which is that you see a sharp rise in the lead up to the global financial crisis, then a correction, a plateauing, and some reversal. And if this looks familiar, this is a very similar chart to what you would see for any chart about globalization more generally. So capital flows followed broadly the same pattern. And so when global capital flows peaked and plateaued, you also saw similar developments in the capital markets. Now, in the region, which is the green line right here, there's also some specific factors, which was reversal of Pillar 2 pension reforms. So this combination of a fall in global capital flows and specific local factors led to a reversal. And so indeed, what you see is that the depth of the capital market is very small in this region. Of course, some of this reflects different multiples. The average PE ratio in CESEE is 10 versus 22 in the United States. But even if you corrected for that, the region's capital markets would still be far more shallow than what you see in advanced countries, in Asia, and in the US. So a way of understanding that is looking at how firms fund themselves. So this is the US, the original Euro area, and then the 8 countries in Central and Eastern Europe that we're looking at. So what you see is, first of all, compare the yellows. Europe in general is more of a bank system than the US. Second is the blue. You see that stocks and bonds are far larger in the US, smaller in the original Euro area, and very small in the CE8. And then most importantly, you see that external financing, the red, and green, which is own funds, are very large in this region. So the region basically relies on FDI/external loans, their own profits, and some bank loans. You can also look at this from the household side, where you see the decomposition, again, the same groups, US, Euro area, and Central and Eastern Europe. And you see that, actually the legend has disappeared here, but you see that in blue, oh no, the legend is at the bottom. So what you see in Europe is that there's a heavy concentration in primary and secondary real estate, far less in financial assets, which is the red, and financial assets are primarily deposits, which is the yellow, not the orange, which is financial instruments. So you have a region, particularly in Central and Eastern Europe, that is largely saving through deposits and real estate, far less in the financial instruments. So now we'll talk a little bit about what we see as the motivation for changing this model. So again, there is a deep skepticism that I've seen in the region for this change. So I'm a visual person, so I find it useful to talk a little bit about what is it that what we mean when we're talking about deepening capital markets. So this is the standard identity that national savings funds national investment. National savings includes both domestic and foreign. And then national investment, we're looking at how firms finance fixed capital formation. Now, normally, this is intermediated by the domestic financial system, where you have financial intermediaries, including banks and non-banks, and then financial markets. But you also have ways of bypassing the domestic financial system. And what you see, this is the current system, you see that domestic savings basically go to banks, which finance fixed capital formation through loans, and you see retained earnings and FDI. The top arrows should be pointing at the banks. And what we're really talking about is moving to a different system that has 3 main changes. One is that more domestic savings would flow directly to non-banks, which is pension, insurance, mutual, and private equity, which then finance financial markets or firms. The second is that you would have retail savings, more of it go directly into the financial markets. So in the US, 60% of families hold stocks, of which 1/3 hold them directly and 2/3 via financial intermediaries. And then finally, you would have more foreign savings going directly into financial markets rather than through FDI and external loans. And so this is a chart that I find interesting as a check on what we're talking about. The x-axis is the index of financial markets depth that I spoke about at the beginning. The y-axis is GDP per capita. And so what you see is that the CE8 region has had a huge increase in GDP per capita, not relying much on financial market depth. Meanwhile, Southern Europe, Latin America, and East Asia have had huge increases in financial market depth, far less increase in per capita income. So this is just a point that, number one, the region has done very well without it so far. Number two, other regions have had big increases in financial market depth with relatively little per capita income. So the relationship, it depends on how you do it. Which brings us to what we see as the case for relying more on market financing. I think there's basically two categories that one can think of. One is that the current financing model is fine, but convergence could happen more quickly via capital markets. So we know that there's a deficit in the capital stock, and that basically by capital markets finding higher returns on capital, you could increase the motivation for savings. By having more competition in the financial system, you could drive down the cost of capital and increase in investment. But I would say that the second, third, and fourth points mentioned here are more about arguing that the model thus far that CESEE has relied on may not be as sustainable going forward. And 3 points here. One is that the availability of FDI may change going forward. I think this is something that we do not see in the data yet. The share of global FDI that the region is attracting has actually risen in recent years. There's obviously an increased discussion around China being able to, or wanting to invest in the region to have access to the EU. But I think this is a big source of uncertainty that we see risks going forward. The third point is about innovation. One of the points of convergence is that you start to have technology that matches those from the countries that you're converging towards. At that point, transfer of technology can be less of a driver of growth. Imitation becomes less of a source of growth, and you need more innovation, which capital markets are better at doing. And then finally, the green transition. The size of projects in the green transition and the maturity of projects lend themselves to pools of investors with longer assets that need, longer liabilities that need matching. So this brings us to the more interesting discussion, which is the policy challenges. It's not too controversial, the stylized facts that I presented in the first section. And the second section, one can debate how much longer, how much more runway the region has on the financing model so far. But there's broad agreement that the region is certainly not at the point where there's excessive capital market development. So there's merit in going further. I'll talk about three aspects here. First is the demand for financial assets. The second is the supply, meaning the need for issuance. And the third is the context in which the market in which it operates. So first, the demand side. This is what's driving a bit of the reaction of my friends. So this is a comparison of returns plus the standard deviation, where you see in the middle the returns of the stock market in Poland, which is barely higher than a government bond, significantly less high than housing, and has much higher standard deviation. So this is the environment in which we're asking households to take on more exposure to the capital markets. So let's talk about three pools of capital pools of savings that people often are seeking to attract into the capital markets. The first is pension funds. So pension funds are routinely seen as the savior for capital market development. And it's true that if you look at the period in the region when IPOs were most numerous, that was a period in which Pillar 2 pensions had very large contributions. But what I find a bit strange about this is that they are often viewed in isolation from other policy goals. So in order to have Pillar 2 and Pillar 3 pension development, it's either necessary or implicit that you have a fiscal cost. In the case of Pillar 2 pensions, you're diverting contributions from Pillar 1 and creating a very large transition cost. And in the case of Pillar 3, you have tax preferences that are incentivizing contributions to these voluntary pension funds. So it's interesting, if you read some of the discussions on capital market development in Europe, there's a lot of jealousy about the state of pension funds in the United States, but it's important to recognize, actually at the same time that those documents are being published, there was a discussion recently at how the pension funds in the United States have come at the cost of the first pillar pension and have not served lower income people particularly well. So both in terms of the fiscal cost and in terms of equity considerations, one needs to balance what it is that we are putting to these pension funds. It can make sense to do, but it's not without a cost. And that's one of the reasons that the Pillar 2 pension funds have been reversed in several countries. I think the second is the retail investors. Banks have been surprised so far that depositors are keeping so much money on their accounts at negative real interest. And so there's the question as to why they are not allocating those funds into domestic capital markets to get higher real returns. But the problem is that you're basically asking households to invest more in relatively illiquid markets that don't really capture the dynamism of the economy. So, when I ask them how they sell these retail products, in Poland, 40% of the stock market is state-controlled firms that have a series of concerns about corporate governance. So the option that households have, it's not entirely irrational that they are choosing real estate over that. So the question is how you increase the number of the type of options of savers products that you can make available to household savers. And then the third is foreign funds. In Poland, there's 450 firms on the stock market, roughly. Foreign investors need $1 million in turnover roughly as a rule of thumb, in order to invest. Out of 450 firms, only 20 have that amount of liquidity. And the strategy of relying on institutional firms to develop the capital market also has a double-edged sword because they're largely buy and hold, which reduces the amount of liquidity. So there's a challenge to how do you develop the capital markets relying on institutional funds, knowing that that reduces the amount of liquidity available. So in each of these cases, there are trade-offs in terms of how you incentivize more purchases of domestic assets. And then there's the supply side, which is encouraging more firms to issue. What you see is the green line is the number of listings of IPOs, which has declined over time. Basically, the very sharp rise period is during the rise of contributions under Pillar 2. So the first question is there sufficient startup capital to create the firms that would want to list on the stock market? And there, what we see is that private equity, private debt, venture capital, all of them are struggling to raise funds to allocate domestically. What the venture capital people say is that there's still a shortage of wealthy family, large net worth individuals. And of the ones that have created, of the large net worth individuals that they haven't converted into family offices yet. And so perhaps some of that is a matter of time. What you hear from the private equity and private debt side is that it's still very difficult to attract domestic institutional capital because of regulatory constraints on what they can invest in. And then finally, there's the point that foreigners find the scale of assets still too small to invest in. And so they do not allocate capital to the region. I mean, the second is the terms. Routinely, when we say that the bond market offers less collateral requirements, longer maturity, and more fixed rate, but when you look at the Polish corporate debt market, it is almost entirely on floating rate, half of which still requires collateral, and the maturity is not longer than the maturity provided by banks. So it's important to note that in the first inning of capital market development, the terms that we think of as the benefit of capital markets are not immediately available. So this is something that comes with time. And then finally, there's the SOE issue. SOEs were a driver of capital market development in the beginning, and then privatization lost steam. But still, several of the sectors that would be most attractive to foreigners are still heavily in state hands, including the energy sector in Poland. There was an article yesterday in the paper about how CalPERS, the largest public pension fund in the United States, was seeking investments in emerging Europe in order to decarbonize its portfolio. And the problem was a lack of assets to purchase. And this includes the fact that the state is very dominant in several sectors where foreigners would want to purchase. So availability of assets. And what I would conclude on is the issue of capital markets union and segmentation. It is shocking how national in mentality the discussion around capital markets development is. There is a sense that domestic savings should be what finance domestic investment. The home bias of domestic savings is seen as a feature rather than a bug, even if it reduces returns. And I think one important way of thinking about this is that the overall goal is to maximize savers' returns and ensure firms have access to capital. And the question is how to achieve this. I mean, in the United States, if you told a teacher in Ohio that what they should do with their savings is invest in a small portion of just the Ohio economy, and not even the most dynamic portion at that, they would think you're crazy. They would want access to the entire US and the entire global economy. This mentality is not shared domestically. The feeling is that in CESEE, as opposed to Western Europe, foreign capital will never come in size to the smaller firms, and that there is no scope to rely on that entirely. When you think about these depositors that are sitting with excess savings making negative real returns, if the only other option is relatively undeveloped markets, it's not entirely irrational. In the US, what you would think of is they should have access to an ETF that is very liquid and is highly diversified across assets in Europe and in the world. Whereas here, that's not the same mentality. It's as if the next step after saving in the domestic market should be going into this rather illiquid, smaller market. And I think that is just a change in mentality. I think there's one specific challenge to that is just that whether the smaller firms will be able to access credit going forward. So I think that this is, in a large market like Poland, it is perhaps easier to overcome, but even in Poland, it is very difficult. I'll stop here.
Thank you very much, Jeff. The presentation you delivered was excellent, to the point, and to be honest with you, as expected. So Jeff is IMF regional senior representative headquartered in Warsaw, Poland. I would like kindly to invite panelists to take their seats. Yes. Please find your, Deborah, you're here, mark you there. Yep. I'm very pleased to introduce, in my opinion, most senior and relevant speakers for the topic, for the purposes of the topic of the second session of this conference. Dr. Deborah Rivoltella is a chief economist at EIB. Dr. Mark Davis is EBRD regional director for Central Europe, based in Zagreb. Mr. Petr Koblitz is since 2004 CEO of Prague Stock Exchange. He is also a member of the board of directors of Vienna Stock Exchange. Mr. Ingo Bleier is Chief Corporate and Markets Officer and member of the board of Erste Group Bank since 2018. He is a chartered financial analyst. Mr. Margus Udam is founder and partner of Karma Ventures, venture capital fund. He is also chairman and board member of the Estonian Venture Capital Association. Let me proceed with the common question I have for all of you. What is, in your view, the state and development of capital markets in the CESEE region? Among challenges like fragmentation, lack of depth, and illiquidity, which do you consider the most pressing for the region? What factors contribute to varying levels of market efficiency and depth across different countries in the CESEE region, and what do you see as a main common obstacle for closing the development gap with the most developed European markets? Deborah, please.
Thank you very much, and it's really a pleasure to open this panel and to be invited in Portorož again. I think I really enjoyed the previous presentation. I think it was a great picture of the challenge for capital market development in the region. And what I think it's very important is really this message that what we really care about capital market development is, on the one side, to have adequate return for investors, and the other side, access to finance. And particularly, I think for the region, the very important element is also finance for innovation and growth of the firms. And I think this is a key element to have behind when we talk about capital market development. I also think that in the region, and I think it's the link between the first and the second panel, the rule of allowing some of these at least access to finance was very much related to a combination of the banking sector and financial market. But there we really still see that particularly now the gaps are increasing somehow, and partly because the banking sector is changing its role compared to what it was before the financial crisis. At the time of the financial crisis, the banking sector, maybe with some exaggeration, and the governors in the previous panel were pointing to it, but there was a very strong role of the banking sector in terms of accelerating and supporting the growth. It was maybe excess, so it was a rebalance, a lot of conservativeness in the banking behavior, but that means that at the end, part of the rule of intermediation that was played by the banking sector is somehow gone. A much more stable situation, but also much less competition. And I think the word competition continue to come in the discussion. There is something that is happening in the region, and I think it's quite interesting, and it has a potential, particularly on the competition side, to make a rule. We see, if you look also at the development of market in the region compared to the rest of Europe, you see a bit more competition coming from fintech. And that's something interesting that has also, with the generational change, a potential to become much stronger. You have a center of competence in the Baltic region, quite strong, but is diffusing quite fast in the region. And to me, it shows that on the banking side, there may be a little bit too little competition on some market, particularly on transaction, exchange rate, dealing, etc. Then when we look at the stock market, I have to say I've always been skeptical, and I really like the presentation of Jeff because it clarified a couple of points. I was always a bit skeptical on how capital market integration, regional capital market integration, really the stock market, that could really make a difference when you really want is the European, and already the European market is too small, but really you want the European market integration. But where I think the region has some potential, and also institutionally we are doing a lot, is on the financing for innovation, more with the whole process of supporting from business angel to venture capital, venture debt. And I think there we see some areas of excellence. One, I think we will talk later, is definitely in the Baltic region, but the market is gradually developing, and we see really the opportunity that may come from that. The venture capital market, it's true, it's still very much depending on a lot of external financing to the region, so it's not yet the mechanism of having the national financing going to financing the innovative companies, a lot of international finance, but there is a lot of also of institutional, and also the institution I'm coming from, the European Investment Group, particularly with the European Investment Fund, is actually, as a fund of fund, is playing the role of market creators in many areas. And there is another element maybe that is interesting. It's not only venture capital, I think venture debt is also an instrument that is starting to play the role. We have a few examples of venture debt financing in the region. It's interesting because it's an instrument that is not much developed, was not very much developed in Europe overall. We started playing with venture debt development in Europe and also in Central Eastern Europe with a few cases. And what you see is that basically through the venture debt, we prepare firms to get at the next round of financing a much better financial structure. So it's really something that helps in the later stage development of firms. So it's something that helps the growth of firms. But if I have to quickly wrap up to your question, I think the big point for the region is still not to think about domestic capital market deepening, but it's integration into the European capital market. We have a chicken and egg problem, if you want, because the European capital market is not fully integrated per se, so we need to have integration of the European capital market and integration of the Central Eastern European capital market into that. So I really hope on the policy point of view there may be a new big push in this direction. And it's important because it's not only a financial sector problem, it's also a real economy problem. And I make an example. We just published a study on green innovation and green patenting companies. And it comes out that, of course, a European level, it's not only Central Eastern Europe, it's European overall. It comes out that Europe is still decent in green patenting, green innovation. Of course, China is picking up very fast. But when you ask the firms what do they need, really there are two things. One is finance. The second one is an integrated market for their product. So the integration of the market is not only important on the financing side, but also on the real economy side to create a size of the market for firms to grow. And with that, I spoke more than my 3 minutes.
Thank you very much. Mark, please.
Thank you. You had asked me to speak about the regulatory and legal environment for an efficient capital market. So I'll be a little bit pedantic. But the key thing for efficiency is that you have breadth, depth of market, and competition. That's very difficult in the CESEE region where you have all different exchanges, all different regulations, different bankruptcy legal requirements, different tax regimes, different CCPs, different CSDs, and different systems on the market. If you're pedantic about this, you go to the MSCI, how they evaluate a developed market or an emerging market status. And it's 18 categories according to 5 definitions, five groups. The first one, and all these are relevant, they come out and when you think about this market. Openness to foreign ownership. So equal treatment of foreign and domestic investors, foreign ownership limits, you can think of Wizz Air in the Hungarian market. But that raises where not more than 49% can be foreign, but that raises the issue that there are multiple reasons for these things. It's not just about developing capital markets. I remember in 1989, I was looking at the US airline market, and at that time, you couldn't have foreign ownership in US airlines. So there's policy issues that come into the overall regulatory framework. The second one, ease of capital inflows and outflows, and in particular, obviously, it's repatriation of funds. And who knows about repatriation of funds until you're in a crisis? So that's hard to evaluate. The third one, efficiency of the operational framework. And obviously, this is something that can be worked on. The software systems, the trading systems, clearance, custodial, and central counterparty. The big one that everybody talks about is the availability of investment instruments. And this is basically breadth and depth. And for that, I think there are 5 companies in the CESEE region that qualify for the market cap and the liquidity for a developed market. And it's difficult for some of the smaller economies to have those kind of companies. And it's also a major issue when the size of the corporations that would list locally, i.e. in CESEE, versus the bifurcation, because when they get to be a certain size, they go to the US. If you look at UiPath, it was a $32 billion valuation in the New York Stock Exchange as a tech company. They didn't list in the local market because the market was in the US. So there's a bifurcation. You have smaller companies with a certain level of financial sophistication. They may be extremely good. For example, if you look at you look at supply chain in the car industry, these companies may be extremely good at making the widgets in that supply chain, but they're not necessarily sophisticated in terms of their capital structure and the way that they face markets. And I don't want to say they've been spoiled, but they've been spoiled a little bit by the mediation from savings to investment by the banking system and liquidity, which allows them to borrow what they need without having robust capital structures and being sophisticated on capital markets. And it's costly for them to go to the market. So you have this bifurcation, which is a real problem. And then the last one is the stability of the institutional framework. And here we get to the legal and environmental instruments and standards. And these become extremely important. I mean, if you go back to capital outflows and inflows, it talks about, if you look at the efficiency of the framework, it looks at whether there's a derivative market in place. Derivative market depends on what the bankruptcy rule is in terms of counterparty settlement in case of a default. All of these countries obviously have different legal and regulatory frameworks. And this is why EBRD has come out with a concept document for a unified capital market within CESEE. It's a wicked problem. Wicked problems require multifaceted solutions over a period of time, so it's not surprising that this is taking time. But it talks about a federal system, recognizing that there will be different regulatory and legal requirements in the local markets. It talks about, within that federal system, starting to integrate, and that is integrating things like the CSD and the CCP, the CCPs, and the software. And then at a later stage, consolidations being unification of ownership, which gets at the issue of this isn't a Pareto improving situation, right? It's clear that the anchor to make a unified system is going to improve capital markets, improve financial intermediation. It's going to reduce cost for the exchanges. It's going to reduce costs for market players. It's going to create revenues for everyone. But there are losers in this process, whoever happens to own, independent clearing software systems, et cetera. But we think that it is a problem worth trying to solve, partly because of the sophistication of the people involved. A college of supervisors to work on unification of the regulatory requirements, and a college of finance ministers to work on some of the legal and regulatory issues. It's a stepwise process, but we think the prize is quite large for that. I'll stop there, but if we come back to the nuts and bolts of corporate finance in this region and getting the ecosystem not only around just corporate finance, but also the venture capital and the more sophisticated, to try to move up the value added in the production chain. We saw the slide in Europe. It's way behind. In CESEE, it's way behind in terms of being high value added production companies. And the definition of rich companies in the world is that they export high value high value-added goods and service to each other. So CESEE needs to get in that group, and we think the capital markets will be a major part of that process. Thank you.
Mark, thank you very much. But could you also give us your view on where we are regarding the capital markets development in the CEE region?
Where we are. Look, we just. I'm very excited about the Premier Energy issue yesterday that was announced in Romania, because I was in the beginning of that. I think I originated that deal and was involved with the owners of the company trying to think through where to list this thing and how to do it. It's daunting. I mean, here's a company that has, it's an energy company in Romania, but it also has the power distribution and some generation in Moldova. So you're looking at doing an IPO of a company that has Moldovan exposure. You want the Romanian market there, but you also want to have access to international investors. They issued about 120 million euro for 28% of the company. It was more than 3 times overprescribed. It had a valuation of roughly 500 million in the end. But the choice there was things like which market will people participate. If they go to the Romanian market, the international investors have to register locally. But under the hydroelectrica, they had to register locally. That was an earlier decision, but that's such an attractive asset. It's green, it's huge, there's going to be liquidity. Everybody was willing to come, so they got international investors to register. So riding on the back of that was an advantage. They had to go green. Okay, so this is a company that's in gas distribution and gas generation and other things. They signed a framework agreement to go green. They improved their green corporate governance. They started buying renewables. And then on top of that, the owners of this company are 2 ex-Citibank M&A bankers. They know exactly what they're doing. And they ended up going to Citi to be the main arranger. I would suspect that was expensive. Was it worth the cost? They gave a discount to domestic Romanian investors to participate, so not equal treatment of foreign and domestic, but they got roughly a 20% allocation from pension funds and retail investors. And then they got the internationals in, and it was a highly successful issue. And I think that's very exciting. And it talks to one, I'll stop, but it talks to one last issue that we often don't want to mention, except when people talk about MSCI, they always talk about, well, the SOEs have to issue because that's the way you get liquidity. If you go back to Premier Energy, and I was involved, it was under my adjustment loan at the World Bank in 1999, we actually privatized the Moldovan power distribution company to Union Fenosa in 1999. Willy-nilly, over the years, it gets purchased by Emma Capital, which owns Premier Energy. It gets integrated in, and then we do a second round. Now, what was interesting about that, for me, to look back after all those years and say, did we do the right thing in 1999 to privatize, was that the tariffs for households in the 2/3 of the company that was covered by Premier Energy were almost 1/2 of what they were in the households where the state was. And that's because by private ownership, the capex went into making the system more efficient and the tariffs went down in that part of the country. So I think, that gives a sense of the importance of, it's not only, openness to foreign ownership, but it's also openness to private ownership. I'll stop there. Thanks.
Thank you very much, Mark. Peter, what is your view on the state and development of capital markets in the region?
Good morning, and thank you very much for inviting me. I have probably a little bit broader view because, as many of you know, I'm also the president of Federation of European Stock Exchanges, so I'm really watching over, I'm really interested in what's happening also in other markets, not only in CEE, the last couple of years. I think the capital markets in Europe are in deep crisis, to be very polite, they are much deeper than crisis. It is a deep crisis, and we are very much comparing ourselves in the speeches before and in some presentations. Sometimes there is a comparison to United States numbers, and sometimes there is a CE, Western Europe, if you want, comparison. What is happening last couple of years in CE and how the markets are looking like in the last couple of years in CE, they're actually very similar to Western Europe. Largest IPO last year was in Romania. Amsterdam didn't have an IPO for 2 years. Okay. The number of the listed companies went down by 29% in Europe over the last 8 years or 9 years. I have the statistics somewhere. The market velocity of the European stocks are between 50 and 100%, US 200 plus. So this is the major problem. we are in a problem as whole Europe. It's not only this region. The problems are actually very similar. There is a big advantage on the original member states of European Union. They were building their capital market in a splendid isolation, so they built some volume. So with the volume perspective, as Jeff had in his presentation, they have still bigger percentage of the ownership in the capital markets over the GDP, so it's looking like, but it doesn't improve, the last couple of years. It is simply what it was in the beginning of 90s or maybe end of the 90s, where those markets were markets in Germany and maybe France and UK were much more similar to US markets, and we were really different. Now, unfortunately, the European markets are tending to be very similar, regardless if it's Czech Republic, Poland, or any other, like the ones in Belgium and Portugal, which are, by definition, developed markets. So we have to have a look at it from the Europe-wide perspective. Have to have a look at Capital Market Union, and I'm very much was listening to Carmina, what he's saying, Capital Markets Union. Because my strong belief, we have to build a functioning Capital Markets Union with a plural before we make a Capital Market Union. United States, we have Capital Market Union. Actually, that's a place we should look at. Very, very often I hear in Brussels, United States are okay, but they are not, where we should head in. We should really develop the European capital market. Well, I think it's wrong. They are really good, and they are doing that right. We should simply copy some of the things that they have there. What is the major difference? For example, if there is 3 weeks, there is an interesting IPO, 300 million euro in, let's say, Spain, a company from Zaragoza doing an IPO in a Spanish market. You guys would not be allowed to buy it. There will be no chance that you go for this IPO. You probably would not even know about it. That it is enormously difficult to do cross-border business, and not because the Spain have a different software than a Slovenian stock exchange. Yeah, by the way, Slovenian stock exchange have the same system as Germany, Austria, Czech Republic, Hungary, Budapest, and Sofia. It is not a problem of the systems. And then there is another system of Euronext also having 10 clients. So there are some odd ones with their own systems, but the systems are completely interconnected. All the investment banks in the world have access to those systems. All of them have it in front of them. All of our data, all of their data are on Reuters and Bloomberg, but still you would not be able to buy this Spain biotechnology IPO because it would have to be golden plated by the local regulators. Somebody have to distribute it. It's probably done by the smaller Spanish bank who doesn't have offices here. Now, what is the comparison? You mentioned Ohio, Jeff. There is a Ohio company, and they are doing IPO in the United States. And there is an investor sitting somewhere in a prairies of Montana. Okay, he gonna be able to buy that, obviously, because it's gonna be done by some bank which have pan-United States activities. It's gonna be prepared probably under the law of Delaware, where I'm coming to the good point by Governor Vucic of the 28 system, maybe. Well, Delaware, is it like one of the systems which is working in the United States? It probably is. It's going to be securities law of New York. It's going to be listed on one of the exchanges there, traded probably on many dark pools, many places. But the investors sitting in Montana would be able to buy that easily. They will be offered to him by one of the banks. He will invest in. So will do the other funds and smaller pension funds all around the United States. And this is how the capital market works. How we do it in Europe, should we do it quick and dirty? That we simply say there is one stock exchange, one system, whatever. Well, then is a problem with the smaller markets. Because, for example, if hydroelectrica would not be done in Romania would be probably very far from being upgraded in a MSCI index to at least emerging market status. So we still have to nurture the local environments, the local ecosystem, as Mark has mentioned. They have to be there, but they have to be alive. The foreign companies, the foreign banks, will not help the 200, 300 million deals done in Prague, Bratislava, or Bucharest. They will take their nice jackets and fly in only if there is 1 billion deal. The smaller deals have to be helped locally. But if locally there is not enough fees and not enough deals, to feed them, then we have a problem. Then the capital market basically ceases to exist. So we have to develop these capital markets in order to make the union of them in later stages. So I would say we are sometimes building the house from the roof. We should build it from a basis. Carmine, how long it was ago when we were speaking about I don't know why European Union is built for 60 years. We don't have a single accounting standards. That's ridiculous. All the people who have to go to the capital markets have to have then local GAAP and then IFRS. Why the hell we don't have the one accounting standards? EU GAAP. And you can go on, with these kind of things where we have to be built very quickly in order to create the capital market union. A local ecosystem, there is, for example, one important thing. There have been some presentation in the first panel about the presence of the international bank on the smaller markets in CEE, on the markets in CEE, not really smaller. Poland is big. Yeah, they are there, but they are very much focused on the quick, profitable wins. We had 18 IPOs in Prague market over the last 5 years, both on the junior market and the big market, the regulated market, if you want, or prime and our SME market. One have been done by branch of the international bank who bought previously one of the local banks. All the others were serviced by the local small boutiques. There are some international banks who have a great equity capital market experience, know-how and knowledge, in their head offices, but they don't have anybody on ground. Anybody. They just don't care about this part of the market. There's not enough deals. Well, maybe they should go around, and try to speak to the clients, And actually, this transaction was done by Erste Kasper, but still only one. So we need to see more ecosystems, more development, more unification, and more capital markets union before we can do United States of Europe, capital market union. And I will probably follow on an index problem, which is my big topic. But let's keep it for a second.
Thank you very much. What is, in your view, the state and development of the capital markets in the region? Ingo, please.
Let me disagree a little bit with the colleagues here to make it more interesting. I think it's not so bad. Yeah? We are a bank listed in Vienna, Prague, and Bucharest. We have a market cap now of close to 20 billion, today at 19.5 billion, which is pretty close now to our book value. A regular dividend payer. And we have grown over the years out of a small Viennese savings bank because of access to capital through the stock exchanges. We could acquire foreign banks. We have diluted the core ownership now down to 11% of our capital. And we have a large retail clientele across Central Eastern Europe. Now, it's true that the capital markets in CE are still very small, but there's a lot that you maybe don't see, and above all, they're growing. We have more than 1 million in securities savings accounts, where savers do not put their money into savings sites or term deposits, but every month 50, 100 euros into securities accounts that go into our funds. We're the largest fund manager in Central Eastern Europe with more than 80 billion in assets under management, and this grows because of steady inflow. I get to the pension funds later, which are very important because also there is a steady inflow. Now, as we are a listed animal and we know the equities market very well, we recommend to companies to list as well. There's very few, and I fully agree here with you, there's very few who want to list because the additional amount of regulation that comes to them in comparison to the capital they raise obviously is not attractive. What do? They go to the private markets. So there's a very significant amount of capital market deals that you don't see in the public equity or bond markets. And I'm really looking forward to your words because I think that the venture capital and private equity market has grown in significance in Europe very substantially, not only on the equities front. We see a lot of credit funds now. And I'll leave you with one example. The largest leveraged buyout in the last years in Austria was not funded by banks, but by a single credit fund, underwriting 1.5 billion euros in buyout debt. Bullet, no covenants. We could never do such a deal. So the reason why you don't see some of the bank lending now is because it's moving to credit funds. On the equities front, the reason why you don't see a lot of listings is not because there are no investments in companies. They're coming from private players. I have every month private equity funds, family offices coming in asking where can they invest. There is no shortage of capital. I also disagree with the notion that we cannot fund innovation. Innovation finds capital. You've brought the IT sector in Croatia. There's fabulous examples of Croatian IT companies that found American private capital in very significant size. There's European capital as well. So innovation funds money. Maybe we don't produce enough innovation with literacy, with the university systems, with what we are doing in education. So I think the capital markets are there to support, good enterprises, good ideas. The capital is there. It's maybe not channeled in the most efficient way currently, but it's certainly something that is growing strongly. So I'm rather optimistic, although I see a lot of hurdles that my colleagues here mentioned. But out of our daily practice, I must say, we do a lot of business in the capital markets, and not everything is seen on the public capital markets area.
Thank you, Ingo.
Just for the opening.
Markus, what is your view on the state and development of capital markets in the region?
Yes, hi. And I'm tempted to say good to be back. Because in 2000 to 2004, I was working for Minister of Finance in Estonia, responsible for state budget, tax policy and economic policy. And at the time at CESEE events, innovation, startups, venture capital was never mentioned. The focus was, of course, joining European Union and NATO. And I'm so positively surprised how much these topics are discussed now. And I would say the timing is now. Timing is now in a sense that the venture innovation ecosystems to build up, we are in early phase. In startup funding, there is pre-seed, seed, A round, B rounds, and so on. We are in seed phase. US has developed since 1970s. And they have gone multiple of hype cycles and crashes, identifying what's hype, what's not. We are in a very early phase. And in very early phase, I'm thinking two things are needed. One, which doesn't fit to formulas or graphs, is luck. Or maybe, better word, catalyst event. And for Baltics, the catalyst event was Skype. The biggest engineering office, Luxembourg had headquarters, UK had commercial office, and globally more so. But the fact that we had engineering office was the biggest spillover effect for new angel investors, for new startups, and to some venture funds. This catalyst event, I think it's important that it doesn't have to happen in every single country. It has to happen in the region. And you have in your region already several catalyst events, which leads to the second point, which has been mentioned earlier several times, is collaboration. But collaboration, to the point of earlier panel, pride, national pride, should not be input to policy making, but output of it. And the whole Baltic ecosystem for venture funding, the very influential part of it was Baltic Innovation Fund, which was created around 2014, 2015, in participation of 3 Baltic governments and European Investment Fund. Now, if I draw back, the catalyst event, the lucky moment was Skype exit around 2005. It took time to get early angel investors going, to get new startups going, you need some track record to prove that the asset class is viable and to convince investors who have never invested in venture before that it makes sense to invest in venture fund and bring their capital to the market. To the point of also previous panel discussion, is there a value that some of the banks are locally, domestically owned versus not? In Estonia and Baltics, the banks are, most of the banking sector, the banks are from Sweden, but there is one locally, domestically owned bank as well. They were the front runner of starting making investments in venture funds. And Baltic Innovation Fund, where 3 governments put money into one entity, and the European Investment Fund as well, was the professional evidence that the investment that will be made will potentially be profitable. Pension funds, which are in a big picture governed by Sweden banks, to a certain extent they might have local decision making. In bad times, they might not have local decision making at all. To the depths of the market, in good times, it's not needed. In good times, fragmentation doesn't exist in venture markets. In bad times, if there is no depth, if there are no local investors investing in venture funds in startups, the ecosystem can collapse back 10 to 20 years and wait good times to come back. So I would say in some of the areas, the truth might be gray, what could trigger it. But on collaboration, I think the key was really that Baltic governments decided to act together and not in a selfish way. Karma Ventures is backed by Baltic Innovation Fund as well. We invest, as by limitations, 50% to Baltic countries, but we don't have country-specific limitation, which is very, very, very important. And rest of the money, 50%, we can invest across Europe, which means it is very tempting for public sector, for governments to say, okay, whatever I put in this one, it has to come back to our country. But it limits the potential, it limits the return potential, it limits the creating proof points that the asset class can be successful. Building the track record comes with compromises. And one of the compromise might be exits to US, saying very bluntly. In our practice, we have done since 2008 about 30, 40 exits, 80% of the exits are going to US. And it helps to create a proof point. Mostly in deep tech sector, US is buying a lot with attractive prices. It helps to create proof points that asset class is viable. Unfortunately, Europe is not buying yet in a similar pace. The listing is, in terms of listing these opportunities, they are great if valuations are in billions. And if their valuation is in billions, most often the main market is US and some European markets too. So unfortunately, it leads to more listing in the US. And again, it's a compromise to develop the ecosystem so that we would have proof points of success. Some thoughts in these angles, how we have developed it in the Baltics. I think we will have significant challenges coming up in coming years. We had Baltic Innovation Fund 1, which created several venture funds and private equity funds. We had Baltic Innovation Fund 2, which helped to repeat the cycle. And looking ahead, I think the whole global venture market was in a significant hype from 2018 to 22. The results of this hype are not visible yet. There are not enough write-offs yet, and the assets are still valued quite highly. Returns will come down, and this will be exactly the time when domestic markets need to have depth to support continuously the venture funds to keep investing. Because to get to an established venture fund, it takes roughly 20 years. 20 years. So in 5 years, you show nothing. In 10 years, you show that first fund might be successful. In 15 years, you have shown you have raised second fund, which is nothing yet. It takes 20 years. So just to put into perspective how early we are in the development.
Thank you very much. We already got the context on regulatory, legal, tax, technological, and other requirements for efficient capital markets. Peter, I would like to ask you if you could briefly elaborate on what stock exchanges could do more to actually attract more issues to list stocks on the stock exchanges and to actually also list bonds there.
Okay, thank you. Well, stock exchanges are basically a technology company with some kind of PR trying to establish around the market, and that's about it. You know, they are not self-regulatory companies. They are not writing the rules. You know, the rules are mostly coming from the pan-European regulations, MiFID, MiFIR, you know, EMIR. There are so many of them. So those are the rules which are coming, and but what we can do, we can speak with European Commission to make less of these regulations. The definitely situation is went too far. Simply, if you see now how prospectus is how fat material prospectus is, what kind of questionnaire should individual investors sign off when they are coming to the branch in Vienna, to the Erste branch, and want to buy a Czech stock or Polish stock. This went too far, and I hear from the younger generation many times, yeah, well, you are doing that wrong. You know, what do we do? You know, I can do my crypto investment within a second. Okay, well, let them do that. I don't agree, but I think we should have a level playing field. You know, it should be the same way. Either we cut many of the regulation and we put some regulation on these crypto stuff. Also, I think the hype is already a little bit over. Or we get lost, you know, somehow we lose the new generation. So the regulation is simply too far. Things like research unbundling was for me clear error, should be then again led to the less availability of the research. So there were a couple of things. Where we probably as European Union should look at the problem is the problem of the market classification from the index companies. The word change, you know, there is like, it's probably 5 years ago when it happened, 7 years ago, when volume on the funds in the world which were managed passively surpassed the stock pickers. You know, so now most of the money in the world are managed basically by 4 index companies. They are not asset managers, they are index companies. They create somehow the index, methodology of the index, and more than 50% of the funds are simply blindly managed based on those decisions. Yeah. And there are things which, a couple of them were mentioned by Mark, some requirements. 18, you said, there are some volume requirements. Volume requirements, for example, in MSCI for Slovenia mean that Slovenia would never, ever become developed market whatsoever can happen. Yeah, because simply will not produce 5 companies with a market cap of 10 billion euro. Never. They are simply not here. So it can have a GDP higher than Switzerland per capita, but you will be always frontier market. You will be on the level of Kyrgyzstan because of these market classification rules. Another example, in the market classification rules of many of the index companies is there should be a functioning derivative market. Do we have a functioning derivative market in Vienna? No, of course not. Do we have it in Belgium and Brussels? No. Do we have it in Amsterdam? No. But they are all developed markets. And you know, the argument that I don't have a developed derivative market in Prague, it goes directly against the European Union kind of thinking through the EMIR. Let's unify at least the CCPs, because the CCPs, there is some logic inside the unification of CCPs. Because this is about risk pooling. Therefore, there are very few derivative markets, very few commodity markets, and very few CCPs, because it's about the pooling the risk. The bigger pool is, the risk is smaller. So obviously, it's nonsense to have individual CCPs in some of the countries. They should be pooled. And then there is no reason to have a derivative markets, obviously, also. So there are things which are simply 20, 30 years old thinking. You know, it's looking at as a national states, at some of the, of course, at the states, you know, which are watching. So I think this question of the indices, if you make a map of the indices in Europe, what do you see? You see the map Europe 1989. There is a iron curtain, exactly where it was. You know, the countries are on the wrong side. You know, our countries are on the wrong side. And not only because, but we have, most of our regulation is unified. Most of our regulation doesn't limit, you know, the foreign ownership of the capital. This thing is there. It's, I think, pan-European, that it should be owned by the European investors in order for them to be able to lend. I think it's very specific, you know, in the airplane industry. But I don't think that there are in our CEE countries any limitation to foreign ownership in the moment. You know, simply we ticked everything all out, except of, for example, that we don't have enough sizable securities. But there will not be, because simply the economy is not such as big. So what we need, and what we start to speak in the European Union about, create a pressure on these index companies to say Europe is one investment place. It is a one developed market because rules and whatever. And then there will be more bigger issues probably coming also from the countries which are now unclassified or classified as a frontier market. I think it's quite controversial because some of the small markets say we are better off if we are emerging rather than developed. We're going to be smaller in developed and bigger in emerging. But I think, you know, this is the thing we should do quick and dirty rather than speak about it for another 20 years.
Thank you very much. Ingo, could you please discuss what the role pension systems could play on the capital markets development in the region?
Yeah, gladly. I think they are very important. I really liked Jeff's presentation. Although he also came with a word of caution, you know, with the competition with the public system. The pension fund system in Europe is way too small on the private side. If you look at surveys, what people are missing, and very often you come to the quote, we miss long-term capital or patient capital. Pension money is long-term capital. Yeah? Stock markets, you get long-term capital. Pension funds are very important long-term investors in the stock markets, in the bond markets. And I don't understand, with the demographic situation in Europe, that the reliance on state-funded systems continues to be so high. We advise all our clients to go into private retirement savings, and where possible, in good Pillar 3 systems. The European Union came out in 2019 with a directive on the pan-European pension plan. You know how many companies, how many providers are listed on the EIOPA register for providing pan-European pension plans? One. So small Slovak fintech. Yeah? Finax, the only provider under this, you know, what was meant to be a great European pension plan system. Because of the underlying fragmentation that we have in every country, a different tax system, different incentives, significant political risk. What was mentioned earlier by Jeff in a very diplomatic way. Poland and Hungary nationalized part of the Pillar 2 system to get it back into the, you know, realms of the state budget. So the political risk in this segment is very high, but also the risk that the state budgets over the long term will be able to fund all the pensions in decent size is very high. So we encourage our clients to go into private pensions. We are really fostering also a discussion around pension fund management. We own some of the pension fund managers. Immediately the reflex is always, of course, you know, the bankers, the asset managers, they just want to make fees off pension money. But in nearly all the markets, this is capped. Yeah? We cannot charge whatever fees we want on the pension funds we manage. But I'm absolutely convinced that this is one of the key drivers of a successful capital market system. And here the difference between the US and Europe is very stark, but also within Europe. If you look at the amount of pension assets in Denmark, And Austria, it's staggering. Yeah? Denmark, I think it's around 200%, 180% of GDP. In Austria, less than 10%. Yeah? So it's really a very, very small asset base in most of the markets where we operate in. It can grow, it must grow, but the environment is not conducive for it. Yeah.
Thank you very much. Deborah, could securitization play a role in debt capital, in capital markets development in the region?
I think in terms of securitization, so as an institution, we are quite active in the region. We have done some 30 securitization in Central Eastern Europe, but 21 are synthetic securitization, only 9 are true securitization, and they are all in Poland, the true securitization. So I think it's a very strange market that is developing, and that at the end is a market that remains on the synthetic part. What we see in the market is that is a market, and particularly the bank looking at securitization, they really want the first loss part. That's something that everybody is asking for. We see that we can bring value, actually, if not with the first loss, that for us is very difficult, is with a very big size that is not there. So it's the scale that really makes the difference, but the scale is not there. And then on a policy point of view, we see very much the relevance of the policy goals on our side that are whether you have a portfolio of a green, a portfolio of something that is gender or something. That's our policy development, and it's very, very difficult for the banks to produce. So at the end, it's a market that is evolving, but at least for us, it's evolving slowly. Because we see the same thing at the European level, actually, with all these thinking of what we can do in a revamp of capital market union and trying to move faster, we are trying to look whether there is a room at the European level for some form of platform for securitization, particularly on green securitization. And we think there could be a good demand, particularly for smaller size banks that are, and particularly probably for the region. But it requires a lot of standardization at the end if you really want the market to develop. And then what we feel very much is that the market is also on the support of the securitization. There is a lot of domestic support also coming from National Promotional Bank, etc., and they have their own standards. So setting standards that are really standardized, uniform, is very, very difficult. But it would be something that makes the difference. So we are committed. We are actually now looking into the opportunity of building platform for standardized securitization all over Europe, particularly probably the niche is the green part.
Thank you very much. Margos, what are the key lessons that can be learned from Estonia example?
Coming back definitely to the point of collaboration as one thing, and looking at the region over here, the more countries and government could join creating instruments, investing across the region, the better it is. Our first initiative was Baltic Innovation Fund, 3 Baltic countries. We are working a lot to get Scandinavian Nordic countries to join the next initiative. It gives broader opportunity and it gives steps to the market. It increases probability that the outcome of the, let's say, initiative will be profitable. If it fails, the trust of LPs, limited partners who invest in funds, will be wiped out for another 5 or 10 years. I think we have one certain challenge at the moment as well. The stock market has been growing since 2008. And when it started to correct, then generative AI saved the world, at least for the first time. It came out and it created hope for more efficiencies, profits, and so on. and big tech stock started to go up again, which has led pension funds and fund managers to think index is performing better than venture and private equity. And whenever the pension system allows individuals to choose which fund to invest, increasingly allocations are growing to index versus pension funds' ability to invest in venture. To be seen what the impact this will have on the market, and we are quite uncertain about, let's say, 2 to 5 years ahead, what will happen to LP base in Baltics. But this is definitely one trend to keep in mind. On regulation, I'm tempted to say that there is all good mind or all good thoughts behind creating more unified regulation, and on surface it looks like so. In practice, we don't want to board investors from US. Keep away from retail. It's from regulation-wide, it's too tricky. AML, KYC processes have to be in place. In practice, implementing them in our last fundraise, 5 investors says, we cannot take it anymore. We were able to convince them to come back. It ended quite well, but and they are unified processes across Europe, but they are in practice operate in a way that it's increasingly hard actually to build the wider LP base for funds. It is going back to fragmented versus with a good attempt to make more unified market.
Thank you very much. We are running behind the schedule, but nevertheless, I would like to ask audience if there are questions, please. Yeah.
I would like to ask Mr. Blair about the experience in Austria, and what is your opinion about the possibilities in Slovenia to establish investment platforms for equity capital, for example, like Kickstarter, where also the Slovenian companies were very successful for gaining the capital, then Zopa in Great Britain, Prosper in the United States. What is your idea? Could this project be successful to integrate all the bases and to divide the small and medium-sized companies into 4 groups according to this life cycle: seed up phase, then startup, initial growth, stable growth, and to manage this platform as investment bank and give the possibilities to households and individuals to invest their savings. For example, savings in Slovenia are around 27 billion euros. What's your opinion? Could this model also be successful, and what is the experience in Austria? Thank you.
Selling venture capital to retail is tricky. You are locked up for 10 years. It is a significant volatility in earnings. And you should have only a small portion of your individual savings in illiquid equity investments. That's our advice to retail clients. Having that in mind, we have a lot of wealthy clients that we invite to invest in venture capital and private equity. There is no shortage of private investment platforms, venture capital funds. We ourselves as bank invest quite significant amounts in venture capital funds and private equity funds. So I don't think that you need publicly organized investment platforms. I think what you need is you need to develop within the banking sector the right methodology to be able to distribute those. So we have set up in Austria, because we refer to Austria, we have set up a separate private equity advisory within our private banking business to be able to advise properly on various fund solutions. It's not something for mass retail. The mass retail goes into broader-based funds, into a much wider risk diversification. A very important investor for venture capital are the pension funds. I mentioned earlier the long-term nature of those investments. Now, the mass retail should invest long-term in venture capital through inter alia, through pension funds. Yeah, so we are very much keen to develop private sector type solutions. And our experience is that in the one segment in retail where there's at least a certain wealth, you can distribute those products. Mass retail, I don't think it's the right way to do in terms of direct participations.
Thank you very much. I would like to thank the esteemed panelists for these insights, and thank you very much to the audience as well.
We were right in time, at 0.
Sorry?
Welcome back to our third session of this very interesting conference. I hope you had a nice lunch, and I hope you all got a bit of coffee so that we can have a good session this afternoon as well. We will be discussing the policy responses to financial system challenges and global trends in this session. So we've heard a lot about strengths and weaknesses of the financial system in the Central, Eastern and Southeastern European region. We'll build on that, and we'll talk about the implications of those strengths and weaknesses for economic growth, for financial stability, and for monetary policy. And we'll also talk about the role of capital markets, especially against the backdrop of increased efforts to build a capital markets union in Europe. There will be room for questions at the end, so I hope you have brought some, and keep collecting them, please. But before we dive into the debate, I want to welcome to the floor Yoshiki Takeuchi. He is the Deputy Secretary General of the OECD. He will deliver a short keynote speech on financial challenges, what they are, where we can find them, why we need to fix them, and most importantly, how we are going to do that. So please, go ahead. And I don't see him actually. So we can give him maybe a minute. Maybe he's getting his coffee fix. And I thought I was going to be late, but it looks like if we... he's coming, okay. Then we will give him a minute. I hope. Sorry. We will deduct minutes. Yes. No, he promised me he had some very interesting remarks focusing on the solutions. So I am in suspense, and so should you.
He got a bad Italian habit of being late. But Ambassador, I'm one of the few Italians always on time.
Well, now I suppose he just will have to deliver an even better speech. Yes, so as we search for him, maybe I can entertain you a little bit. No, No, I'm not much of a stand-up comedian, so I have to warn you there. But I did learn a lot about this part of Europe, focusing mostly on the Western European side in my day job. And one thing that I thought was really interesting, and my panelists can already brace because they will be getting that question from me as well, is that there is so much potential and so much opportunity in this region, and so many things that seem to be low-hanging fruit, and here he is. So I raised the expectations quite a bit for your speech. So,
oh my God.
So over to you.
Oh, sorry for this. I thought it was from 3 o'clock. I made a totally mistake because when I was having a good chat with the governor and Alfred, I thought I had some more time to prepare. But let me try. And since this is the first speech after the good lunch, I hope I will not bore you. But since we had such a good discussion this morning, the first session and second session was so interesting that I don't think there's much I could add, but let me try. So thank you very much, Governor Vazul, and thank you, Alfred, for inviting the OECD for this very interesting and important conference. It is my pleasure to be here today to discuss the pivotal role that financial and capital markets play in driving overall economic growth. As an organization dedicated to fostering international cooperation and development, the OECD continuously advocates for market-based policies that contribute to the advancement of financial and capital market worldwide. In recent years, the Central, Eastern, and Southeastern European CESEE economies has made significant progress in development and integration of their markets with the broader European Union. Yet, much like in their counterparts in the EU, there remains work to be done, and the pressing concern that demands our question is the issue of access to finance. Despite the progress, a significant portion of firms in the CESEE region are still financially constrained, with 9.1% reporting financial hurdles exceeding the EU average of 6.1%. Too few companies have access to market-based financing, while many others face huge costs when seeking for bank loans, or worse, are outright rejected. Addressing these challenges and the necessities that the challenges necessitates the establishment of robust banking system and vibrant capital markets that provides business with resources they need to thrive. It was pointed out in this morning's session that the banks in this region is robust. Yes, they may be robust in a financially perspective, but robustness also should mean that it is functioning in the sense that it serves the business as well. Let me paint you the picture. Currently, the majority of external financing received by non-financial corporate sector in the region is sourced from banks, accounting for a mere 47% of the region's GDP, a stark contrast to the 78% seen in the EU. In addition, market-based financing facilitated through equity and corporate bonds constitutes less than a half of what banks provide, standing at just 21% of GDP, far from 64% observed within the EU. These are the figures actually referred to by Carmine, my colleague, this morning. So let me share with you different figures. While the combined GDP of Central, Eastern, and Southeastern European CESEE economies stand at 31% of EU's GDP, capital market tells a different story. Over the past decade, 10 years, a mere 373 companies have opted to list, only a quarter of those entering public markets in the EU. So only 38 companies opted to list for the past 10 years. And when it comes to corporate bonds, the numbers are even more staggering. The capital raised via corporate bonds in the region represented a mere 4% of the EU's amount. These discrepancies are not just statistics. They are a reflection of the challenges that business face in accessing the resources they need to thrive. And they need to thrive here, in this region. Of course, EU economies face the same sort of challenges, but I think we need this region to work more harder in order to have a more stable growth. But before diving into the specific, it is useful to take a step back and remind ourselves of the purpose of developing capital markets, of why we promote market-based financing in the first place. To my mind, there are three key reasons. Firstly, capital markets promote innovation and access to finance. Their capacity to mobilize large amounts of capital from a diverse range of investors make them uniquely well situated to financing long-term, large-scale ventures. There is a reason that United States railway networks and United States capital markets developed in unison, as President Lagarde noted in a speech. Capital market also provides the risk-willing capital necessary to develop nascent technologies. That will be crucial to realize the twin, green, and digital transition, as well as to ensure its broader competitiveness. Secondly, the capital market provides a resilient, counter-cyclical type of financing that allows us to weather economic turmoil. In the wake of both the 2008 crisis and the pandemic-induced crisis, companies globally, especially those that were already listed, turned to public capital markets to issue record amounts of both equity and debt, over $7 trillion in total in 2020 and 2021. This allowed them to overcome the downturns even as bank lending was contracting. Not having that access can be perilous. As the Eurozone crisis reminded us, when the balance between bank-based and market-based financing is lopsided, a debt crisis can become prolonged and extraordinarily costly. Thirdly, there are means to enable broad public participation in corporate wealth creation. It is a question of financial democracy. Millions of citizens depend on the functioning and the dynamism of capital markets for their pensions and for their private investments. It is important not to forget this point. The benefit of capital markets can be benefit to society as a whole, strengthening the link between the prosperity of the broader economy and individual households. With these benefits in mind, the case for market-based financing is clear. The issue is that capital markets in the EU and in this CESEE region are currently not big enough to fully leap them. The EU is one of the world's largest economic powers, but for a range of indicators, let's say public equity issuance, total market capitalization, and corporate bond issuance, to mention a few, its share in global capital market activity is smaller than its GDP would suggest. Aside from the broader drawback of hampering growth, this has two related but distinct impacts. First, on competitiveness. None of the world's 10 largest technology companies are listed in the EU. Only two of the top 20 are. The US hosts 7 out of the top 10, and Asia, the remaining 3. Simply put, scaling up globally competitive companies in frontier industries require ample risk-willing capital. Secondly, on a smaller company's access to finance. Discussions about capital markets often center around the biggest companies. But equally important is the fact that underdeveloped capital market leaves smaller, innovating companies with less access to funding than their peers in place with more developed markets. But these are the companies that grow to become the next global champions. They are also crucial in their own right, as small companies, 2/3 of employment in the EU comes from SMEs. So this underlines the importance of CESEE region and EU to continue developing and integrating their capital markets. But for any policy to be successful, it must be first identify the root causes to address, not just the symptoms. In the EU, one of these issues is, of course, fragmentation. Fragmentation in trading, in taxation, in supervision, in rulemaking, in capital markets more broadly. This leaves a mosaic of national markets with limited ability to harness the potential of a single market for capital. In the CESEE region, on top of fragmentation, the development of financial system remains as an important issue. Despite recent progress, in particular due to the accession of many countries to the EU, there are still notable gaps and challenges that need to be addressed to bring these economies closer to the level of the EU counterparts. Let me name a few. First, many CESEE countries still have relatively underdeveloped financial infrastructure compared to the EU counterparts. The lack of deep and developed capital markets combined with a timid banking system prevent the corporate sector from continuing to expand. In some countries, the banking system is dominated by state-owned banks or has only few and small banks. All of these factors result in a lack of competition, leading to higher costs for consumers and providing less incentives for banks to improve their services. Secondly, the regulatory environment in some CESEE countries needs to increase its transparency and predictability to be more conducive to financial and sector development. In the face of burdened government financing and the persistent challenge of structurally difficult access to bank finance for emerging and innovative enterprises, it is evident that CESEE countries urgently require for further development of their capital markets and a broader array of financial instruments. This imperative extends to the harnessing the potential of institutional investors, including pension funds, insurance companies, and investment funds, who can play a pivotal role in providing much-needed financing. However, it's crucial to acknowledge that in the CESEE region, the assets of institutional investors remain notably below the levels observed in the broader European Union. Here, I would like to mention a bit more about things that has not been referred to in the morning session. In order to have a lot of investment, we need to win the trust of the investors. We need to have a good ecosystem. It's not something to do only about the capital markets. And here in the OECD, we are working to improve the ecosystem of this investments thing. Give me an example. Corporate governance. We have made a big change in the corporate governance principle last year, and that would encourage each country to make sure that the companies that they are looking after are responsible in the sense that they are contributing, for example, to the climate issues. Responsible business conduct is another one. Responsible business conduct is very unique in the sense that it is not for the governments, but it is for the companies. With this responsible business conduct, then if you have those companies that is abiding by those sort of things, investors would be more interested. And it is very important for each authorities to make sure that the companies that is in your country is abiding by this responsible business conduct. And there was an argument about that the reason why there was the decrease in the amount of loan from banks is from the demand side. But as I've said, we should always stress the importance of small and medium-sized enterprises. These companies are, as I've said, the next champions of the global economy, and they provide lots of jobs. So here, OECD not only focuses on how well the importance of the capital markets, but we also focus on the ecosystem of the investment with this corporate governance, responsible business conduct, and we also make sure we have a working party dealing with small and medium-sized enterprises. And there, of course, we also have to reach out to the investors. And then, as some of you have also mentioned, financial literacy also matters. We have also some works on financial literacy, and it's quite interesting that when it comes to financial literacy, it's of course very important to give this education to younger people. But nowadays, younger people think they are quite versed with ITs. They are quite confident they will not be cheated by this kind of attempts. But what's actually happening is that because of the lack of financial literacy, those younger people are more prone to this deceit scheme that would make them lose their money. And this is very, damaging for this younger generation. So as policymakers, we should also be mindful of how we look after younger generation, taking care of the financial literacy. Of course, financial literacy applies to older generation as well, but we should also not lose sight of the younger generation. So while many countries in the region have made progress in integrating with the EU financial markets, there are still barriers to full integration, including regulatory differences, currency risks, and limited cross-border investment flows. Addressing these challenges would benefit CESEE countries and could also support the efforts of reaching greater integration, be it capital market union or banking union. I was very much interested in the argument of whether or not harmonizing 27 systems or trying to go for a attempt for the 28 system. That is a very important point. But yes, it's not enough just by talking. So you should get together among us. And OECD here to participate in that sort of discussion, to find out the best way, short way, to come up with a more integrated vision. So let me finish, ladies and gentlemen, by apologizing first for arriving late, but second, assuring you that we very much look forward to working together with you to have a more vibrant and sustainable market here in this region, which has lots of bright future. Thank you very much indeed.
Thank you very much for those very insightful remarks. I would like the panelists to come up to the podium. and join me here. We have Marcel Haag, the director, a director in the DG FISMA at the European Commission. He is dealing with Capital Markets Union, with sustainable finance. So the true expert on this panel. We have Governor Bosjan Vasley, of course, our host, and we're grateful for the invitation, all of us. We have Martin Kazaks, the governor of the Latvian Central Bank, and we have Governor Holzmann from Austria, whose institution is looking very closely at the region, so another true expert as well. And with that, we can get our discussion started. Now, the pessimists among us might be walking away from this conference thinking there are a lot of weaknesses in the region when it comes to the banking system. And Governor Vasley, I'm wondering, is there reason to be optimistic as well? Are there strengths that we have maybe not talked about in the way we should have in this morning's sessions?
So thank you, and good afternoon to all. I think the most important is to remain realistic. What was very striking for me when I was listening to various presentations today is that there was always one typical chart. And this was this division or splitting the whole globe, the whole world in 3 different categories. At one side, at the highest of the curve, there were always the United States, their policy and their approach. Then, lagging behind was Europe, Euro area, and then inside this group, it was our region which was at the very bottom. So I think that we have to be very realistic on that, and that is that situation at the moment is not the best one for us. We are not very well positioned for the needs and for the wishes of our economies, of our citizens. And then to be more optimistic, on more optimistic side, the fact is that it seems that there is also an agreement that we know what the solutions are, that we as I said, we have an agreement on how to continue, how to proceed, and we only, what is missing is the readiness, the preparedness to deliver on these solutions.
Governor Holzmann, how do we find that readiness, that solution, and are there maybe low-hanging fruit that are just there to grab?
Thank you. First of all, thanks for the invitation here. Thanks to the people who are in charge of putting the different discussion groups together. The morning was fascinating. I have to say I learned a lot, and hope we can live up to the competitive standards which was established this morning. Low-hanging fruit hardly ever exist. So I think we will have to work for it. And I have a few proposals which I will run through later on. But first of all, I would go back. I mean, I've been in the region before, during, and after the transition, and what has been achieved altogether is fascinating. I have to say it's really great. And yes, there's some needs to do now the next steps, but this is not too different what happens in Western Europe. So I don't think the gap is so important. And I see 3 areas there. 2 we talked about, and 1 there's in the middle, definitely at the level of the banking system, how to say, which is, as some said, it's very robust, well established, but a little bit, I wouldn't say lazy, but it would require a little bit of competitiveness, a little bit of competition. My sense is that, how to say, those institutions there, they are somewhat the relevant institutions there. They have little competition from the outside. They can't fear it, and the non-bank sector, as we've heard it, does not really exist there. So for me, the main question is, how can we put competition to that? It may still happen from the technical side, so even if we've heard so far it hasn't happened there, but it also may happen, to say, from a side, it may not be expected. And one of the things which came out of the discussion is that banks, they do their business there, but they're also involved through companies in the investment business. And here I'm also getting a bit nervous, because what I see and have seen also in the past is that this is the way they want to capture the whole business. They don't want to have the competition there. So my sense is important getting competition there. But here, what I was a bit afraid of when I saw the data is that in many of the indicators what we have with regards to share of outstanding credits compared to GDP, how low it is and how low it has remained, because this is something which matters for monetary policy. Because if and have you have low outstanding credits, in this case you have a less effect on your transmission mechanism. So it is our interest as central bank that here the banks are in a shape close to what's happening in the West in order to do that. How to get my competition in, I have to say it's not my speciality, but I do hope some of the people closer to competition will have some ideas there. Thank you.
Well, Governor Kazaks, you've been nodding very intensely. Let me ask you: how do we get competition in, and especially against the backdrop that we have, or we are talking about a banking system that is very diverse, with some markets being dominated by regional lenders, other markets by subsidiaries of international banks. We've talked a little bit this morning about private ownership versus public ownership. How do we get competition in such a complex market?
Thank you, Jana. But before I answer your question, I want to say big thanks to Boštjan and Alfred and the teams of the organizers. Thanks for having me. And I think I was nodding. It was not a coffee impact or something like that. But I think all the discussions that we really have had today are right to the point. And unfortunately, we are all in the same boat, because we have exactly the same problems, only kind of different to degree. But by and large, I think step one, we are recognizing that there indeed is a problem. And now let's see how we can go about it. And I think in the earlier discussions, it was also very, at least in my view, clear to see that global financial crisis was some kind of a structural shift. If I, for instance, take a look at my own country, Latvia, or the Baltics, we saw too fast and excessive credit growth in the run-up to 2008. But after that, we by and large have seen massive deleveraging. Latvian case in that matter is extreme. In 2008, just before the crash, we had domestic loans to GDP at 100%. Now it's below 30. Okay. It's been continuous deleveraging for long 15 years. The economy has been growing, but the economy has been growing without massive support from financial services. Okay. So that's an interesting element to look into as well. Why and what allowed the economy to grow. But in terms of the financial market supporting growth, and banks for that matter, it's been largely insufficient. As for capital markets, they are still small. In the Latvian case, capitalization of the equity market, let me exaggerate a bit. It's at 2% of GDP, because in real life it's 1.8, so it's by and large nothing. Okay? And it's not good. So that means there's lots of potential. Let's see how we can unlock it. And I fully agree with the initial statement by Boštjan in terms of the problems that we have in the financial sector, that the banks are, and the financial deepening is too small. The lending practices are too primitive, mainly against assets. Okay? And capital markets are, very, very small. So for our level of development, where we currently stand in terms of GDP per capita, financial markets are way, way too small. They are too thin. As to your question with respect to, if I may simplify it somehow, home host issue. Do you want local banks or foreign banks? In our case, 85% of the banking market and bank lending is by foreign banks, predominantly Swedish banks, which is a fantastic source of stability, but we are lacking agility in the market. So the banks are very efficient, cost to income relatively low, profitability extremely high. Last year, some banks just a bit south of 30%. Very profitable business, but it does not get transmitted onto the economy in terms of the services that we would like to see. So in terms of home host, I very much agree with Boris's point in the first panel in terms of the best outcome. The first best would be really true pan-European banks. But unfortunately, first best will take some time if it will happen. So in the meantime, I think the second best in terms of some local banking activity, which has more skin in the game in the local market, which is more agile, and also in some case also more forward-looking, as in the previous panel the Estonian representative said, would still be necessary. So I would say we need some local banks that act as agitators, as a kind of disturbers for the banking sector. Stability we have, but we don't have growth. So we need elements to create growth, and some local banks, privately owned, not state-owned, would be necessary. Okay? But that is a temporary kind of solution. Of course, at the end of the day, we need markets that are not fragmented. And fragmentation, in my view, is the major problem for Europe. If we can have the kind of regime number 28, fantastic. Okay? I think that's one way to go about it. But unifying 27 is difficult. And then let me conclude with kind of perhaps a policy ambition of something like that. If you have a choice of a lot of nothing or a bit of something, I would go for a bit of something. So creating more of a common market, removing the fragmentation, unfortunately also losing some of national policies and independence, but that would create at least something that we could benefit. Currently, if we stay put in the current regime, we are simply losing out.
We'll talk about a bit of something and about growth in a moment, but you also mentioned stability, and I think that is very important as a foundation. And Mr. Haag, I wanted to ask you, how difficult is it to guarantee and to maintain that financial stability in a region that is so diverse, and that also in a region where some members benefit from the relative stability of the euro and others don't?
Look, I think this has transpired through a number of presentations and comments that have been made already during the day, that when it comes to financial stability, we are in a relatively good place. At this juncture, financial stability risks at this point for the region, but also for the EU at large, are currently mainly stemming from geopolitical and macroeconomic risks, and not so much from individual organizations. It is true that there are some pockets that require close scrutiny and some specialized institutions that we need to keep an eye on. But broadly speaking, I think we are in a good place now. That doesn't mean that we should forget about financial stability. So for us, maintaining financial stability going forward remains the key concern, and we have made a lot of progress since the crisis in establishing a robust regulatory framework that should allow
to maintain financial stability, and that is what we want to keep and not change. When it comes to the development of capital markets, which we can now turn to, and that is maybe a political opportunity. There is a political window. We feel that we should use. There is now a bit of a political momentum at the highest political level inside the EU that we should make a good use of, and further developing our capital markets will also contribute ultimately to preserving and ensuring financial stability when it comes to diversifying the sources of funding, or increasing transparency, improving oversight. All of this will also make a contribution to financial stability. I mean, we should be, and here I never disagree with the governors of our central banks. Now that is clear, but I think they are very right in saying we have to be realistic, and developing our capital markets union will not be done in a day. It will be a process. It will be difficult. It will be frustrating, because we will probably spend a lot of time, invest a lot of energy into making progress. But I think it is worthwhile for the reasons that we heard a lot about already today.
We will get to the capital markets part of this debate, I promise. But in the spirit of being realistic, I want to talk about bank lending for a moment first, and I want to do that in the context of economic opportunities, because a lot of business in the region is funded by bank loans, and the phenomenon that we've seen over the past the past months, the past years even, is that there is a gap between demand and supply for that kind of funding. So, Governor Holzmann, a question to you: how do we fix that? Given that for now it seems bank lending is the primary channel at which or through which businesses fund themselves.
I will answer your question as a little bit of a bridge to the second part of it, because yes, there's a gap there, but my understanding concerns the region, but also the rest of Europe, is that banks are good in lending, but they are not good in lending for something which is promising very much towards the future. So if you go to a bank as an enterprise and have a normal investment loan and have a normal expansion or whatever it is, you get the money. But if you are, how to say, a dynamic enterprise that want to grow with 20 or 30% per year, you won't get the money. And this is this gap in the financial escalator, what we have in the West, what we have in this region as well. And this is, how to say, where innovations are necessary. What is it? Such an enterprise with a new technology there, they want to have a lot of money in order to expand. But of course, they don't want to give up their majority ownership, so they're looking for a patient, non-majority contributor, which could in principle be the bank, but they don't give it, but something from the outside. And this gap in the US, it's closed very much on the capital market or by private families. In the West and in this region, it's not closed at all. But there are different ways of dealing with it. And the UK has invented about 12, 13 years ago the British Growth Fund, replicated in Ireland, replicated in Canada, replicated in Australia, which offers such a way in which loans are provided, but not only loans, but also support. The alternative is to have a big family. And I take the example when I was celebrating the 50 years of Austrian Stock Exchange, Vienna Stock Exchange. The youngest and the oldest firm was invited, and the youngest one, a pharmaceutical company that had exactly this problem. They wanted to expand. They had a lot of new products there, and they found it in a Saudi Arabian family. They offered the money because nobody else there. But we need to have such a fund there. It's a little bit what the Kreditanstalt in Germany has, a little bit we Fonds d'Investissement Public in France had, but this is something definitely in the West, but this is something which very much needed in the region, if and as you want to expand there. And we don't have it. I think that's an important point to make here. And I tried it in Austria to do so, and then it was killed by the banks.
Well, maybe it will stage a comeback. Governor Vasile, I was quite surprised by some comments that or some people talking about the lack of competition in the banking sector, and at the same time considering banking consolidation. How do those things go together? Banking consolidation being pushed as a way of making the system better, more agile, and doesn't that take competition away further?
Looking back at the past 30 years, this is the question which was permanently on the agenda. And I think that we tried in different countries, different approaches. First of all, we thought that the privatization of the banking sector will solve the problem, that new owners, different owners, obviously market-oriented owners will improve the situation, but it was actually not the case. And then the second attempt was made through the consolidation of banking sector. And of course, if I just give you an example of Slovenia, we started 30 years ago with almost 50 banks, which is an enormous number for a country of 2 million population and back then $24 billion of GDP. So we did a lot of consolidation, but still situation improved, but not as much as we would like to. Then the third approach was done through opening up of our banking system with foreign banks entering domestic markets. And again, it was mentioned in the morning session that this brought some benefits to our countries, but we were all at the same time somehow surprised, because what we were expecting back then was that the foreign banks will bring to our countries also better banking practices, new business models, new instruments, and so on. But what actually happened is, in many cases, that foreign banks adopted domestic practices. So we had different structure in terms of ownership, but the same business models which were just operated by different owners. So I think that at the moment we are at the border, and this is in the metaphorical sense, but also in the real sense. And the only solution to me at the moment seems to be more of the opening of our economies and more integration at the same time. So what we were emphasizing in the morning, banking union, capital markets union, is something which will bring size to our banks.
Yeah, Governor Kazaks, I wanted to ask you about growth opportunities. If we get this right, we heard about the big potential that companies in this region have, yet the very limited possibilities at the moment. So what's at stake here in terms of economic growth?
Okay, thank you. But let me start with the following statement, that bankers are not bad people, okay? Yes, we would love to see much more bank lending. At the end of the day, before start kind of with career in the central bank, I was chief economist for the largest commercial bank for 13 years. So I think they are, also, of course, decent people kind of on that side of the fence as well. And there are reasons for that. There are reasons why they behave like this. Okay? And we need to tackle those reasons. Before I will go to some of the solutions we hope that we are implementing and will be resultive and will lead to better results in the Latvian case, of course, let me just highlight some of the elements of why it really has slowed down economic growth. Okay? If you take a look at the Latvian economy, what do we see? We see that if the bank lending, our estimates show, if the bank lending of the last 10 years would have been at the level that we saw in the past as percent of GDP, okay? Not at 100, but let's say at about 60 to 70, then our economic growth would have been much stronger because of investment activity, which would have been much stronger. And if currently we are at about 75% of EU average in terms of GDP per capita, we would have been closer to 85. Okay? This is of material importance. What are the likely channels? One is lack of bank competition, lack of more dynamic banking market, given that banks are the major source of funding within the economy. Our lending rates are much higher than EU average. Okay? The spread, one of the measures you could look at is spread between deposit rates, how banks mainly fund themselves, and the lending rates in the Baltic market, and that is quite similar in all three countries, is in the range of 2.5 and 3 percentage points. In Europe, it's just about 1.5. Okay? If your lending rates are higher, what does that mean? It means that net present value of the project is affected. So, there are more projects that are not financed because they cannot give that kind of return. Okay? So automatically we become kind of less competitive. Another issue is regional coverage. Typically what happens, banks becoming very efficient, they move out of regions. Okay? And that means that the lending in the regions, it's much more difficult. Again, weighing down on growth, and we can see our analysis shows very clear market failures. Okay? For instance, mortgage market for cheaper real estate in the regions is non-existent. So banks don't extend mortgages, people are forced to go and take consumer loans, which are twice more expensive than mortgages. Okay? So you get these kind of market inefficiencies. Also risk distribution, who takes on the risk? In the Latvian market, of course, it's very good, and the Baltics overall, very good for monetary policy transmission because the rates are floating rates, okay, very quick. Okay? But at the end of the day, it is the clients who take all the interest rate risk. There are no fixed rate products, okay, of any significance, at least so far, which means that, again, kind of, this is the client who takes on the risk. And I could go on and on and on. Okay? There are those elements that weigh down on investment activity, that weigh down on economic growth. What do we do about it? There are a number of reasons. One is informational issues. Okay, so we try to remove information barriers. We, for instance, in terms of deposit rates, we are publishing bank deposit rates that are available to the clients so that the clients can see where can they get better value for money. Okay, so that to move the clients themselves around. The state treasury started, when the rates went up, started to introduce savings bonds, which was a massive trigger for commercial banks to start pushing up term rates, for term deposit rates, because of the competition again. Outside from the banking sector, from the state treasury, but the state treasury was benefiting because it was borrowing cheaper than in the financial markets, but people had an option to move their assets elsewhere. We are removing regulatory barriers. we're taking away some of the excessive regulatory framework that is making business lending much more complex for banks, so that there are less expenses and less risks on the part of banks. We are trying to remove bad industry standard practices. For instance, if you take a look at the mortgages, then in the Latvian case, and the Baltics very similar in this respect, but the Latvian number was that only 2% of mortgages get refinanced to another bank during the lifetime of the mortgage. And in the Latvian case, the average is about 20 years, and the mortgages are fully amortized. Okay? So by and large, when you get a mortgage, you know, that's for life. Okay? At the terms and conditions that you were granted at the beginning of this contract. Okay? So what we've done, we've simplified the process, removed some of the fees through regulation. Okay? So what we've found out is that simply removing the excessive regulation does not mean that the banks will become more agile. Unfortunately, you have to come up in certain cases with new regulation that pushes them to become more agile. Okay? Currently, we're working on refinancing of corporate loans, because the market kind of standard practice is if you want to refinance, you have to pay a fee of about 1 to 2 percentage points of the loan outstanding. Nobody is going to give you a much cheaper loan than that. So by and large, again, if you're taking the loan, you're stuck for the lifetime of the loan. So these kind of market infrastructure problems are the ones that we are tackling, hoping that it will kind of kickstart more of the competition. But of course, we also look into the banks potentially coming into the market, increasing the bank competition, that kind of stuff. But if return on equity as a standard above 10%, and over the last couple of years, kind of in the range of 20+% does not attract market players who want to share this profit, it shows that fragmentation is a very, very big problem.
Governor Vasile, given you are one of 3 central bankers on the panel, and policy transmission is very important, is what Governor Kazaks was just describing. How difficult does that make your job as a governor or as a member of the European Central Bank's Governing Council in making sure that policy is reaching each and every corner of the region?
Now, to start with, I can join my colleagues who explained before satisfaction with the past developments regarding monetary policy effectiveness and how successful we were in past months, past year with reducing inflation and. But yes, when we are talking about the effectiveness of monetary policy and its equal effects in all jurisdictions, what is most often at the forefront is that we are operating under incomplete monetary union, that we have one single monetary policy, but that we are faced with many other fiscal policies, and this is what is most often described as the biggest challenge. But in addition to that, what we learned during past experience of high inflation is also that there are other structural characteristics of our economies which are making our lives much more complicated and complex. One is that there are very different, for example, labor markets across the Europe with very different characteristics, with very different wage forming mechanisms. And of course, during this episode, when what's happening on the labor market is a bit unusual or very different as compared to the previous experience, this is one important segment which is always in front of our eyes. And then, of course, is that there is also the second element, which is related to how national financial markets are operating, and here again there are many differences, many significant differences, which are
as a result leading to different strength of our monetary policy through different jurisdictions. And what we are seeing, for example, in my country, in Slovenia, is that the pass-through of the interest rates was different to what happened in other countries, that it was visible on one side of the balance sheet, so with lending rates they were increased, but on the deposit side we saw very little reaction, and there is one of the explanations for this situation is that, yes, there is a very undeveloped financial market here. There are not many alternatives for saving which accumulated during the crisis. So we can see this direct relation of what is the main topic of today's conference, underdeveloped financial markets, and how the monetary policy is working in our countries.
Governor Kazaks.
If I can chip in a bit, I fully agree with what Bojan just said, and I think we've very clearly seen a very nice disinflationary process. The second round effects have not really kicked in because of the monetary policy, and we are on the path to 2%. So monetary policy does work. But there are various channels. In the Latvian case, as I mentioned, our loan to GDP is floating rate. Okay, so it's very loans to GDP at about 27%. They're floating rates, so very quickly transmitted. But our analysis shows that in the Latvian case, given that the credit channel is so small compared to other countries, for us the major channel has been exchange rate. Okay, because we are a very open economy. So it's not only through the interest rates that our monetary policy would work. There are also other channels.
I do want to take the discussion and take it to capital markets for the remainder of the panel. And Mr. Haag, I'm interested in your view on your opinion on how you judge the prospects for capital markets development in the region, and maybe you can also share your views on how we can accelerate.
Yeah, as I said already, there is currently momentum. The Capital Markets Union project is gaining momentum at EU level. We have now the European Council, the leaders taking an active interest in the project and are also realizing the urgency of making progress on Capital Markets Union, and I think that's an opportunity also for the CESEE countries to develop their capital markets as part of a wider Europe-wide capital market. I think that there is sometimes this opposition between a top-down approach of an EU capital market versus the bottom-up approach of developing national capital markets. I think this is largely a false debate and a false opposition of two concepts. I believe we need both. There are national specificities that need to be taken into account, and there is a lot that individual member states and individual jurisdictions can do, but it has to be part of the wider ambition of an EU capital market, and here access will be key. Access will allow to take into account national specificities without forgoing the advantages of being linked up to a larger and deeper capital market of a continental scale, and that I believe is an opportunity, and this is a win-win opportunity for all our member states and the EU as a whole, and well, one can see that there is an appetite to look into a number of of points and to explore others. So there seems to be a wide agreement and convergence on the need to look at securitization. Again, this has been a bit of a political stigma around securitization for a while, but I think now there's a real appetite to have a look at this again. We think that we should do this with an open mind and look at both the regulatory framework that we've put in place, but also at the prudential rules applying to securitization.
Governor, oh, sorry.
Yeah, but okay, but then there's also supervision and pensions and a lot of the stuff that has already been mentioned and listed on the slides this morning.
Governor Holzmann, you're looking at the region as such very, very closely from where you sit in Vienna, and I'm wondering the latest push to get forward with CMU at the European level. How much of a game changer can that be, especially for this part of the region, for the Central and Eastern and Southeastern European economies in particular?
If we were to succeed with it, it would be a major game changer. And I'm not sure that everybody is aware how much change is required. Because for the time being, it started out, we want to have a capital market, was repeated in almost every informal ECOFIN that was attended. Sounded like the monster of Loch Ness, we never saw it. Now it's becoming a bit nearer there, but what we'll have there is for the time being, it is an announcement. And the only thing I saw now, I don't know whether it's time to read through the paper by Christian Noyer, who had sponsored it, or it created a little bit more realism there, that if and as we want to succeed, it really needs to revamp not only the capital market, our financial system, but also a little bit how we look at capitalism, which will be quite likely the most difficult part of it, because a capital market is not only something we can do by the order of the Mufti, you need also to want to have capitalists who make decisions about projects or not, and this is a major part of it. I think in order to understand it, what it requires is that we would have to have a major shift in way how people invest. At the moment, we shift a lot of money in the US with debt instruments. We get the money back with equity instruments from their side, which means at the moment they sift everything off. In the future, we want to have local institutions which make this decision there. But where are the institutions coming from? My stronger conjecture is this requires institutions which are called pension funds. But development of pension funds happened in a number of European countries, but in a few of them, to do it here. And it's something which takes time, and also specific ways in order to do it. The Noyer paper makes an allusion to a savings product, which is there, but I'm afraid the savings product won't do it. One of the key issues has to do with taxation, and the taxation of old age income, taxation, the intertemporal taxation, and so far no progress has been made. And without that, it is dead on arrival. But the problem of taxation, and it was the last book I published before taking on this job, The Taxation of Pensions, published in MIT Press. It shows how incredibly complex the issue is, and it would require a major change which in Europe doesn't take place. The second part is, and now coming to this region, I was involved in pushing for pension fund this region a few decades ago, but as we saw it, all of them, with a few exceptions, well, all of them were reduced, and some of them they were dissolved. Now, coming back again, now saying, okay, we want to go back where we were before, it's quite difficult, saying, okay, we reduced the contribution rate from 10 to 5, or we dissolved the money in order to give it to the budget. So in this region, I see a major problem from the political point of view to go back and say, oh, we want to have a capital union, but it needs to have pension funds, and now we do again what we did in the past. And I think Jeff in the morning, he alluded very much to it. Either to say, if you want to revamp the current system, you have to pay double, or else, if not, how to say, you have to have the tax expenditures on the side, impulsive expenditure, at a time when the budget is already very scarce. So yes, I'm very much in favor of it, but I'm afraid it will be a bit more difficult and will go beyond simple changing some laws and hoping the effect will kick in. It will require a cultural change, and whether we are ready for that, I'm not so sure about it.
Governor Vasley, it seems the solutions are all here. We know what we need to fix. And at the same time, looking at the debate around CMU, we have a lot of difficult discussions between smaller and larger states. Governments can't seem to agree. Is there really the political commitment to get it done? Do you see it?
There definitely is a strong political commitment on a very general level, but it is often the case when the details are put on the table, then the situation is slightly different. And according to my understanding, it's exactly what happened during the last attempt, which was on the agenda a few meetings, at the meetings of the ministers a few weeks ago. And that is, at the end, the whole initiative was unsuccessful because of the division of views. And the dividing line was between bigger members and smaller members, and the substance of the division was how to supervise, how to regulate the institutions inside the new potential space. So yeah, as I said, there is a general commitment on a very general level, but there are always details which complicates the final decision.
Governor Kazaks, does Europe have the time then to sort out those differences in opinion and get lost in a discussion of every single detail, especially against the backdrop that we have an energy transition to finance, and we have a lot of challenges waiting around the corner that need to be addressed?
Thank you for the question, which is very rhetoric. Do we have time? It depends on what's our life expectancy, and also, when do we want the result? But on a serious note, I think, come on, people, why do we always need a crisis? Okay, since the kind of previous crisis, of course, we've come a long way. If one takes a look at the European financial system architecture, it has improved massively. And that's why we are in a relatively robust and stable situation. But we are again kind of hitting the wall of kind of these kind of last mile kind of stories. And we need a crisis to really do the decisive things. Let me come back a bit to what already Boštjan, I think, very clearly pointed out, but in terms of the dynamics. If we take a look at the Capital Markets Union and Banking Union, I think that the story a year or 2 years ago was relatively clear. Banking Union, everybody knows that it is necessary, but nobody wants to do it politically. Okay? So by and large, stuck. Capital Markets Union, at that time it was everybody knows that this is necessary, there is a political support, but this is a very complex equation to solve. Banking Union, a very easy equation to solve, but no political will. The problem is now, exactly as Boštjan was pointing out, when we go into the nitty-gritty and in terms of speeding up, this coalition of the willing for Capital Markets Union, then people start to again have second thoughts. And here I want to come back to my earlier conclusion or statement, is that what do we want? A bit of something or a lot of nothing? You know, I would want a bit of something. And this kind of elimination of fragmentation, of building common institutions and doing all these structurally necessary things like capital markets union, banking union, common fiscal facility, it would be extremely helpful. Yes, to some extent at the expense of national levers that we can pull here or there. But then the question is, you know, what do we really want? If we see this as a risk to our economies, then of course I would say we need to do it. And your point on green transition is an extremely valid point. The banking sector, in its current shape and involvement in financing, will not be able to finance it. Capital markets will not be able to finance it. Public sector will not be able to finance it without the private sector. The good news is that we have the money. Okay? There are lots of savings that we can put at work, but the money simply sits in deposits or in real estate. Okay? As we saw, for instance, in this region, where do we invest? Okay? So I think the problem is this intermediary mechanism is not up to the task. And I hope that we can fix lots of things before the crisis hits. Okay? And we should do it, because then it would make us much more resilient when the next crisis hits. So I think in terms of time, yes, we have time. We are still alive and kicking. But can we do better? Of course. Yeah, and we should.
Who do we need to call to make it happen?
Say again, please?
Who do we need to call to make it happen?
As we know from the history that there is no one phone number that will, you know, one single number that you dial when you have European issues. Okay? And that is one of the things that we have to work with. Of course, I'm kind of treading into the area which is nothing, you know, to venture in for a central banker, but kind of decisive leadership is one of the things that we do miss in Europe.
Mr. Haag, given you're the closest to, you know, a member of decision makers in Europe that we have on the panel, will we see a leap forward, or is there a chance of a leap forward after the European elections, after we have a new parliament, after we have a new commission? Is that should that give us hope that something will happen very quickly once those new structures are in place?
Well, I mean, I do not have a crystal ball, so we'll have to first see what we have the elections, and then we will have a new commission. So a new political leadership, But I think all signs are that that there has been a wake-up call in the European Council. Will that lead to immediate deep changes? No, and all of this will take time. It will be difficult. We need stamina. But this is how Europe has been successful in the past, and this is how we can be optimistic to be able to take the project forward, and we will change what can be changed, and other things will have to come. Will have to come when they come. But I think there is a real realization now at the highest political level in the European Union that if Europe wants to remain relevant in a rapidly changing world in which Europe's relative weight is decreasing, it has to do something, and it has to do something in developing its capital markets.
Well, then I hope the right people are listening. I have plenty more questions, but in the spirit of giving you a little share of something, I would like to open the floor to the audience. So if you have questions, raise your hand, get up, wait for the mic to arrive, and then introduce yourself and ask. Anyone? Come on. Don't be shy. Let by a show of hands then, to entertain us a little bit. Who is walking away being more optimistic than they arrived this morning? Nobody. Are you all more pessimistic? No, you just didn't have enough coffee, it seems, after lunch. So if we have a few more minutes, so if you don't have questions, you're welcome to change your mind at any moment. Just wave at me. Otherwise, I will continue to ask here. We haven't talked on this panel, at least, about fintech and big innovations outside the banking sphere. Is that something? I mean, it's definitely something that has made real big progress in the Baltics in particular. Is that something that Eastern Europe can kind of venture out into and become a leader and teach Western Europe a little bit of something?
Thank you. I never thought that we are that good, okay? So, in the Baltics with respect to fintech, but of course that's an area that has been of interest in the Baltic countries, and one of the reasons has also been relative kind of conservatism of commercial banks, which has pushed other market players being more aggressive, or, for instance, through the contestable markets theory, hoping that that fintechs will come in and will take away business from banks and will improve the quality of service for households and corporates and all that kind of stuff. Unfortunately, what we've seen is relatively kind of niche developments in terms of payments. Okay, there we've seen good developments in the Baltics by all means, but this is not only in the private sector. Of course, there is. I think the Kickstarter really that showed that we have the skill and there is money in this business was Skype. Okay, and we heard that in the previous discussion. But there's also TransferWise, which is Wise now, and there's also some Lithuanian developments that are pushing into the financial services. But it's also central banks, and let me brag a bit myself. Instant payments in the Latvian case is an industry standard already for many years. Okay, so that is a standard case where you can transfer money from a bank to bank just like that. Okay, where was it developed? At the central bank. We took on the risk, invested, developed it, provided it to the market. Not everybody really wanted to join in because the large banks already were providing it in-house, but not among the banks, okay, across the market. Now, it is the case. We've also developed, different kind of add-ons on the instant payments, requests to pay and things like that. So it's also the central banks can chip in if the private sector is not brave enough, or there are competitive issues, or there is a lack of scale. And now we're providing those services not only within the Latvian financial market, but also across the Baltic countries as such, and also a bit outside. So fintechs is certainly an outcome. Estonians have also recently looked into crypto, Lithuanians more into fintechs related to payment services and that kind of stuff. So my only thing of advice here is be brave, but manage your risks. Okay? Because managing your risks is extremely important. There are AML issues and all related risks around it. Be very cautious about it. Now, of course, there is crypto regulation coming in. There is access to the central bank payment systems that are hopefully going to be granted within the euro area. So there are lots of developments. At the end of the day, we are working on digital euro. It's still some years ahead, but these are all technological developments that households and corporates will use. And the question is, will we be, as a euro area or Europe, in the front lines globally, and we will benefit from that? And will we have our own solutions that will also safeguard our competitiveness, but also all the geopolitical risks? So that is critical. But this is by all means that we are investing in. We see a benefit from that, and it makes us more resilient. But one needs to take care of the risk management.
I mean, you mentioned the digital euro, which is a very important point. Governor Holzmann, is that the catalyst that may make things happen?
I think this is the important question, and here I'm a bit more optimistic, because that's an area where we spend as ECB, but also individually, quite a lot of resources, where we have a well-established process, where I think we are currently among the two or three forerunners on this topic, and where we reach out to the industry to get involved, to be part of it, and under the assumption that we are able to make the digital euro as the digital money that offers most of the privacy protection, but on the other hand also the best transaction processes. I think we have a competitive edge which others don't have. The US doesn't even want to think about the digital dollar for political reasons. Other institutions work on it, but as regards the cooperation of all countries, 26 and 27, it's even outside the euro what we are reaching out there. I think it's really good, and we can be optimistic about that.
Your final chance. Anyone? It's not. Yes, thank you. Go ahead. There is a microphone coming. And if you could just quickly tell us who you are.
Yes, thank you. I'm Matthias. I work at the Bank of Slovenia. And I would have a question for Governor Kazaks, because he was mentioning a bit this exchange rate channel that's apparently very strong in your economy, given the transmission of the monetary policy. And if you maybe can share a few more details. In particular, was this like a part of the terms of trade channel, like more export support, given, let's say, the depreciation of euro, or was this more through the financial conditions that basically loosened, or what was more exactly the main part of this exchange rate pass-through that you were mentioning, given your high, I think, also share of variable rate in real estate lending? Thank you.
We can have on the sidelines much more detailed discussion. We can, of course, send the paper over, but by and large, all of the things that you mentioned, mix of them. We are a very open economy. Exports and imports make up more than 100% of GDP. So all these trade flows are extremely important, and also outside the euro area. One of our major trade partners is Sweden. Of course, the exchange rate is there. Also, significant impact through the US dollar because of the energy trades. So it's a broad spectrum of the elements that are pushing for this exchange rate channel. Thank you.
Anyone else? Final chance. Yes. There is somebody is coming for you, coming to you.
Yes, it's a bit of a broad question for a final minute. But anyway, Jose Manuel Campa, EBA. I just want to take advantage of the title of the session, which is Policy Responses to Financial System Challenge we'll be talking about, and Global Trends. So policy responses to global trends. One clear global trend that's sitting out there is the possible fragmentation around the world and the globalization. And I was wondering if you have a clear view of how that will interact with this apparently lack of depthness of financial markets in some of the countries in the region. And how should we react to that?
If I may, I think this is kind of these global trends. You can rank them as the good, the bad, and the ugly. Okay. In terms of the good, I think this artificial intelligence, that is a possibility. Of course, coming along with lots of risks, but that is really a possibility to improve our productivity, which again solves other financial sector problems as well. And then climate change, I think this is the bad one, okay, because that comes with risks. We need to deal with that. There's lots of investments necessary. And then, unfortunately, the one that you mentioned, the ugly one, which is geopolitics. And life is not going to be simple. Life is not going to be easy. And I'm not going to go into very much discussion here, but let me just bring out one of the elements, which is the Russian war in Ukraine. Okay? Given that many of us are also neighboring countries in that region. It is, I think, a couple of elements that I would, that's a very long discussion, but let me bring out a couple of things that may make our decision points somewhat easier. Point one, we talk a lot about stranded assets in terms of climate change. And I think we should also talk about the same thing in terms of the geopolitical shifts of what has happened in Russia. So those assets are stranded assets. That's a sunk cost, and as we know from Economics 101, forget about it. Okay, it should not affect your decisions that you make today. So if those assets are there, most likely they are lost. Okay, I think this is point one. Point two, in this region as well, and that is also important for confidence issues, for economic recovery, is what is defense? Is that an expenditure or investment? I would view it very much as an investment, okay? Because of strengthening confidence. And if we take a look at the, for instance, Latvian economy, we see that households have become relatively risk averse. They are saving up. They are not spending. And one of the issues is, of course, this uncertainty. Okay, with respect to geopolitical shifts. We also see this, unfortunately, in terms of government bond spreads. Okay, we are paying more for our debt because we are neighboring Russia. But we are part of the euro area, we are part of European Union, we are part of NATO. Okay, so this confidence impact is important for the economy, and I think investment in defense is investment in our growth. In our resilience, it's not an expenditure, that runs about 3% of government or budget deficit. So, and the last thing to bring this up, how bad could it be? I don't think that this is that critical. Take a look at Korea. They've been living next to North Korea, forever, and they have been successful in developing their economy. So. There are very clear things what we need to do, and let's just do it. So in terms of geopolitics, that is going to be a disturber. That is going to be an issue that is going to drive risk appetite here or there. But with respect to the Russian economic ties, I would say, unfortunately, these shifts are relatively permanent, at least long term. Decouple and devote your attention to elsewhere. And in terms of financial markets, again, cleaning the Latvian financial system in 2018 from all the AML risks meant that in 2022, when the Russia invaded Ukraine for the second time, the impact through financial links was minor, non-significant. So the financial system was very resilient and not affected by those elements. So yes, we can be resilient. Thank you.
And I think that is a very hopeful final word. I would like to leave it at that. For me, it was very interesting. I hope for you as well. And with that, I would like to hand the floor to Governor Vászlé for some final remarks.
Ladies and gentlemen, with that, we reached the end of today's conference, the official part. There will be additional opportunity to discuss during the evening, during the dinner. And at that point in time, I'm well aware that one cannot do a favor by summarizing such a rich debate we had today in a few sentences. So instead, I will just reflect that my main take away from today's event is that we very much agree on the assessment of the current situation when we are standing as a Europe and when we are standing as a region. There might be a slightly less agreement if this is a good outcome or not so good outcome. And what is most important takeaway for me is that we know that we have to do something to improve the situation. And when I'm saying we, I mean us, policymaker. I have in mind my colleagues from the banking sector, from the financial industry, from the financial markets. And we have to do something on at least two levels. The first one is our national level, so where we are in charge, but also at the broader European level. So by that, I would like to thank all of you, especially our speakers, especially our panelists, also to the public for coming here, for cooperating. And I also believe that you would agree with me that it was a very smoothly organized event. And that is due to a huge effort my colleagues at the bank and also colleagues at the IMF invested into this event. So I think a round of applause will be a nice thanks to them.